Cool. Well, we'll get started here. So thanks to everyone that's joining in. We had a marathon session yesterday on the Twitter Spaces, almost 7 hours, I believe. So I appreciate you coming on here on your Saturday as well now and joining in for this. Just a couple things. So just to recap, anyone that wants to follow along with this spreadsheet that I have open, it's on the whitetundra.ca website. If you scroll to the bottom, it will be the first file, I believe, on the bottom of the homepage is this Excel sheet, and you can follow along there. For those who are new, I see there's a few new people here. The usual format is I usually do a macro outlook about 2.5 hours, and then go into this valuation on about 3 different companies. Just this time, we've talked a lot about macro here over the last little bit, and nothing much has changed since the last session. So if you're interested in that, on the website, again, there's a session from January 25th on YouTube and on the website, so you can have a look there and kind of follow along. It covers American shale, Iran, Venezuela, demand in US, India, emerging markets, and supply, inventories, etc. So that's that. For today's format, we'll just go straight into the 3 companies. We'll do a little bit of a deeper dive. I'm going to go through the 2022 outlook, a little bit of projections on Q4, and kind of what we expect for the Q4 results that are coming up here. And I just got to caveat this by saying I'm not an investment advisor, so please don't take any of this as investment advice. This is all my opinion, my research that I like to share and kind of present as well. So that's that. Everyone has their own risk tolerance. Everyone has their own kind of expectations of the market and where you see that. So please do your own due diligence on these. The oil industry especially is very volatile, so it's important you understand what you're investing in and you make sure you're kind of familiar with that. And I just want to follow up on the last seminar. I mentioned that I had got one email with somebody saying that they basically copied my portfolio exactly on the website with the names and the weightings and everything. So please don't do that. I mean, you're welcome to do that on your own accord, but that's not why I post the portfolio on there. It's more so for transparency reasons and just to get my own conviction names out there. But yeah, those are not the kind of emails I want to see. But yeah, just please do your own due diligence. Still follow up with questions and kind of look through the spreadsheets, the company presentations, etc., and make sure you know what you're investing in. I'm also always available on DM on Twitter. My email is on the website, so feel free to shoot me an email. I've had excellent calls with people I've met on Twitter and from these seminars over the last couple of weeks, and it's just been amazing the kind of conversations that are that are created off something like this. The recording will be on the website later this evening, so if everything goes well here with the Wi-Fi, which I hope it does, I will post this here by tonight, and it'll be available for your viewing at your own pleasure. And yeah, we'll get started here. Again, for those that are new, I do send out an email list with the files that I'm going to be using today, so all the corporate presentations and such. So if you want to get on that mailing list, just shoot me an email or a DM with your email. I can get you on there, but it's not that important because if you're going to be joining this or watching this afterwards, the information and the numbers that I'll be going through will be kind of on the screen anyways. So you can kind of follow along that way. So yeah, we'll get started. I don't think there's any questions here so far, and feel free to put questions in the chat as well if there's anything, and I'll kind of follow along. Once we're done the 3 companies, I'll kind of open up the floor if anyone has any questions regarding the macro, regarding the seminar today, my own portfolio, any names you want to discuss, I'm more than happy to do that. And then once that is kind of done, we'll end the Zoom call and go into the Twitter Spaces, and I'll just open it up to further conversation at that point. And once again, for anyone joining on the Twitter, if you want to follow along the visuals, please join the Zoom call. The link is on whitetundra.ca at the bottom there near the events section. Cool. Well, we'll get started. So a little bit of background on this spreadsheet. This is something that I'm kind of developed and now keep fixing up and kind of refreshing with new information and new stuff. It's something that I use for a quick and dirty kind of calculation as to what the companies are doing, what kind of cash flow are they generating. And once I have this done, I believe now with the addition of Kiwatnock and Petroshale, the new companies, I think I'm at 57 now that I'm tracking. So basically I put in the information, I update it quarterly, or if I get some information about the stock that I want to go back into it, and then I find my top 5 to 10 kind of companies, and then do the deeper dive section and go more into the subjective things like management quality, dividend stability, the operations, their reserve life, their inventory, how they're doing, where they have the land, et cetera, et cetera. There's millions of things you can kind of dive deep into at that point. So yeah, so that's what I use it for. It's more of a relative valuation tool, so you can kind of tell the difference between companies, which ones are generating more cash flow as a function of their enterprise value or the value of the company. It can be used as an absolute valuation tool as well, if you're familiar with using cash flow multiples and funds flow multiples, but more so, it's more valuable to me as a relative valuation tool to decide the top 5 or 10 companies that I then look into more in detail. So yeah, that's a little bit of background. I will get started. So we'll be going through Baytex, Surge, and then Pinecliff. And again, this one is going to be a little different because we're going to do the 2022 outlook. And then I also have some kind of graphs to share and pictures to share about the companies and kind of more my insight on what I'm seeing right now today and why these three are kind of being in my crosshairs here. If there's any names you want to discuss at a future seminar, again, shoot me an email, shoot me a DM, and I'll add it to the list. There's a couple names that people are really interested in. So we'll save that for the next one. But so we'll get started. So basically we put in the company name. Baytax is the first one we'll be doing. So just throw that in there. We need the production. So we're looking for the Q3 production, which usually you can find in the financial statements or the MD&A of the company for Q3. They're all available on the company websites. It's open information. So for Baytex, I have the Q3 2021 results. Once the Q4 comes out, I will, of course, adjust accordingly. So we always look for the information that's a 3 months ended September 30th, because that gives us the latest quarter of results to work with. So always look for the 3 months ended. Sometimes companies will report this 9 month ended or year to date or something. So just make sure you're using the right number. And the number we're looking for is this right here. Oil equivalent, how much was the production in BOEs per day? So 79872. So we're going to throw that in there. The liquids percentage. Basically, if you go up here to the highlights, it tells you they generated production of 79872 and it was 82% oil and NGL. So I'm going to put 82% for the liquids percentage. And now we want to divide the liquids production up. So heavy oil sells at a much different price than light oil, which sells at a much different price than NGLs. So it's important to break this down. There's a comment here that NGL is natural gas liquids. So yes, thanks for the clarification. And just to come back on the spreadsheet, all the information you need, if there's any problems, is in this kind of explanation columns here. So if there's anything that's a little bit confusing, I hope to have covered a lot of that in the text here. So we'll go back here and we'll look for our oil. So the light, they break it down for you: light oil and condensate, heavy oil and NGL. So we're gonna basically put these numbers in there. So the light oil is 35,614. The NGL, I believe, was 7174. And the heavy oil is 21996. So we'll throw that in there. And that gives us the total production of BOEs and the split. So of the 80,000 BOEs roughly, this is the split. You know, and that's what the spreadsheet will use to calculate the further numbers. The next thing we need is the shares outstanding. So that's usually in the same sheet. So usually what you're looking for is a Q3 MD&A, which is a management discussion and analysis, which usually gives you most of the information you need on basically everything we need in the spreadsheet. So this is not the number we're looking for. Shares outstanding basic, end of period, roughly 564 million shares. So I'm going to put 564. I did get a couple of comments that the spreadsheet was broken. So just make sure you're following the right units and putting shares in millions. Whatever's in Canadian dollars, putting it in as Canadian dollars, whatever is in as US dollars and so forth. The millions thing is the biggest thing. You have to make sure those units kind of add up. The share price was 522 as of close on Friday. So we put that in there, and that gives us the market cap. So the market cap is the total value of all the company's shares, just the shares. What's the value of all the shares? And that's basically shares outstanding multiplied by share price. So pretty simple calculation there. The next thing we're looking for is the current debt. So again, we'll go back here. We look for the net debt. We always want to look for net debt because there's a lot of companies now, which you'll notice, like for example, Cenovus and Meg, that they're not paying off debt. Instead of paying off debt, they're now collecting cash. So their actual debt is lower than what their current debt actually tells you. So you always look for net debt, which will be your total debt minus your cash, how much ever cash you have on hand. And that puts us at about 1,564, so $1.5 billion. So we'll put that in there. And that puts us to an enterprise value of about $4.5 billion. The enterprise value is the total value of the company. So if someone wants to say, hey, I want to buy the entire company Baytex right now, that's basically what it's worth, about $4.5 billion. There's a question here. Can you give example of NGL? So NGL, natural gas liquids, would be like a propane or a butane most of the time, which are kind of your lighter ends that come up more out of gas as opposed to out of oil. So any of these lighter ends, they don't trade at the same price as oil. Propane usually is like 50% of WTI pricing. Butanes are a little bit more, maybe 60, 70%. It kind of fluctuates from there. So those are the things you want to keep an eye out for. Most companies will not separate out what the NGL is. They just tell you how much NGL they have. So we'll just go with that for now. So there's a question here. What about the non-debt part of the working capital deficiency? So there's usually a working capital deficiency, which is kind of what's the difference between the company's accounts payable and accounts receivable. You know, have they paid their service companies? Are they, 2 months delayed, XYZ? It doesn't really matter. Usually it's such a low amount compared to the total debt that it's not important. And I think it's important to take it into account anyway, because it is an actual debt. Like if you owe somebody $20 and another person owes you $5, well, you're still in a debt of $15. So we still need to take this into account. Even though it kind of changes quarter to quarter, it's still important, in my opinion, to take it into account. So yeah, thanks for that. Great question. And that gives us the debt to EV ratio. So the debt to EV ratio tells us how much of the total company value is in debt. Why is that important? Because if the oil prices start going down and your company is very heavily debted, that is not a good sign. That means that the debt holders have a potential control of the company. They could slide it into bankruptcy. They could cause other problems with the debt. And we saw this big time in March to May of 2020, where some of these debt to EV ratios were like 0.9 and 0.95. I think Athabasca was like 97% or something at one point. So this is quite important. When the oil price is going up, if you believe that the oil price will be going higher, it's not as important, and you might want more leverage, because if you're a shareholder, the more financial leverage you have, the better your shares will do from a valuation standpoint, and the less that the debt is important. But again, that's your own subjective interpretation of kind of what's going on. There's a question here, are you an ENTP? I've never run that. I don't know what it's called, but I've never run myself on one of those calculators, so I don't know. But that's pretty interesting. So maybe I'll do that later today and get back to you there, JP. So thanks for that. The debt capacity is important, again, when the oil prices are lower, and if your debt to EV ratio is quite high, you might want to look at the debt capacity. How much debt capacity do they really have? Like, how much out of their line of credit are they maxed out on? How much more debt can they kind of acquire or pull from if they need to? For Baytex, it's the debt to EV ratio it's pretty decent, so I'm not going to look into that. The stay flat capital, again, is important if you want to track this, just to compare companies. So, for example, Baytex might need about $400 million is their stay flat capital, and that's also in the MD&A. So they need $400 million to maintain 80,000 BOEs of production. And it's more of a relative valuation. Again, if you see another company you do where they need $400 million to keep 500,000 BOEs flat, I mean, that's a better company from a capital efficiency standpoint, and they will have a lower decline rate to account for that. So these things are more important once you decide which companies you want to look into. It's not that important right now, so that's why the boxes are orange. They're kind of optional. Okay, there's a question here that debt is dangerous in environments with rates set to rise. Correct, yes, debt is a big deal, but it's not that important. If we now go through this calculation, you'll see the free cash flow that these companies are throwing out, an extra % on their debt, not that important. It matters more for growth companies, which are maybe more highly debted, and the interest rate actually affects them way more compared to commodity producers, where it's almost like internal hedge in a way. So there's a lot of nuances with that. I don't really want to get into that, but in most cases, the more debt you have in a rising commodity price environment, the better returns on the shares you will get. But again, that's just my opinion. That's kind of what you see on an overall trend. That doesn't mean it's always true. Can you give a general rule of thumb where you don't like a company to go on debt to EV? There's no right answer for that. It all depends on your own personal risk reward calculations. For anyone here who invested in oil stocks in in spring of 2020, they were investing in stocks with 0.95 and 0.96 debt to EVs because they saw the light at the end of the tunnel in a way, or where things were going. And again, it all depends on your own personal perspective. If you just want your dividends, you want a little bit of share appreciation, maybe you want a lower debt to EV ratio. If you want more of a high torque play, you want a higher debt to EV ratio. So very subjective on that. So the next number we need is the adjusted funds flow for the last quarter. So the adjusted funds flow is how much money did the company make after every single expense. So we take tax, we take interest, operating cost, salaries, how much did they pay for the computers in their office, their stampede parties and everything. So if you take all that into account, how much money did the company make? And we get that number from, again, adjusted funds flow. It's right there, in the NBNA. It's pretty obvious. So about 198 million. So I'm going to put that in there. But that's the money that the company made after all its expenses, except the capital costs. So oil and gas wells decline. They need more money put in order to keep production flat, to maintain your production. So we need to account for that, and we need the free cash flow number. So the free cash flow is your adjusted funds flow minus your capital cost. So pretty simple calculations again, and most of the companies will have it somewhere in here. So right here, the first page, generated free cash flow of $101 million in Q3 2021. So we're going to put that in there. And, the rest of the spreadsheet kind of calculates around that. So there's a question here. In any business where pricing is volatile and the industry is a price taker, like oil, a debt to equity of 1-to-1 is a risk. So a debt to equity of 1-to-1 would mean a debt to EV of 0.5. So what John is saying is anything over that is a risk. And I completely agree. In most cases, yes, that's correct. That being said, again, it's all subjective. If you believed in oil in early 2020, in spring of 2020, there was probably not a single company that had a debt to equity or a debt to EV of less than 0.5. So, the high risk, high reward plays will generally be more indebted. And it all depends on your comfort zone. So I can't answer that for each individual person. Quick question: do you tend to look at adjusted funds flow for each company, or do you find the definition is the same? So most of the time it's the same. There are some companies that exclude certain things in there, but for the most part, it's pretty stable, and the free cash flow kind of calculation covers it anyway. Once you take both. So there's that. Now, that's the free cash flow the company made in Q3. However, a lot of companies hedge their oil. So what they do is, instead of taking whatever oil that or whatever price for their oil, that's the current price, they will hedge it, in that they will buy contracts for the future that they can sell oil for a certain price, and they will lock it in. So this hedging impact varies from quarter to quarter, and it affects this free cash flow very materially in volatile times. So when the price is increasing a lot, the oil price, or when the oil price is decreasing a lot, the hedging can have a huge impact on the free cash flow, and thus can kind of skew the actual cash flow generation of the company. So we always want to take hedging impact into account. So the way we'll check that in here is we look for realized financial derivatives loss. They call it hedging loss. They call it financial derivatives, and they call it many names, but basically you're looking for the actual hedging loss. and you want to look for the realized loss, not the unrealized, because the unrealized covers the future hedging losses or the future hedging gains. So realized financial derivatives loss is about $54 million. Because it's a loss, we are going to put it in as a negative, which it tells you here, put losses in negatives. Okay, a lot of questions today. This is great. What is considered decent free cash flow? So I will talk about that here once we get to the calculation part of it, and my opinion on that, and how to frame it. Okay, can you quickly explain the differences between put hedges and fixed hedges? Okay, so there's a variety of different kind of hedges that you'll see companies enter into. There is the most common, maybe not nowadays, but one of the most common ones are swaps. Swaps are basically, you will get this price for the oil and that's it. So it's a fixed price that you agree on. You can also buy puts, which I talk about more in the put option seminar. Again, it's on my website if you want to have a look at that. So basically, you can set a lower kind of line for your oil. So this is the minimum that you will take for the oil, and that costs you some money up front. It's like buying an option. So there's that. There's other hedges called three-way collars, where you kind of buy a range of oil price you can get. So there's many different kinds of hedges. Most of the time, you want to look at swaps and three-way collars. What do I use for share outstanding count? So most companies that are in the Baytex, Surge, Pine Cliff kind of size, it doesn't really matter. It's going to be a 2 to 3% dilution. So it's not material to the calculation. And I want to re-emphasize this, that this initial part of the calculation is just for relative valuation. We're looking for a quick and dirty number as to which companies are generating cash flow. If the company doesn't generate cash flow, why do we want to get hung up on diluted shares and basic shares? It doesn't really affect the calculation. So feel free to use whichever number you want. There are certain companies, the smaller companies like Saturn Oil, for example, that has a huge dilution built into it. So, and Africa Oil as well. So you want to be careful with those companies and maybe use diluted share counts if the difference is a lot. But in this case, if we go back up here, the difference between the basic, it doesn't even have diluted shares here, but the difference is usually 2 to 3%, which doesn't materially affect the calculation. So, okay, let's get back here. The share buyback amount last quarter, Baytex doesn't buy back shares right now, so 0. If the company does, you want to put the money that they spent in there. Okay, so if the company was unhedged, so as a company, strictly an oil operating company, not a financial hedging corporation and such, the company generated $155 million of free cash flow last quarter. Okay. However, every quarter is a point in time. It's not a something you can extrapolate this number as is, because they made $155 million at a certain oil price. We all know that the oil price changes. It goes up, it goes down, sometimes very volatile. So we need to get an understanding of how can we extrapolate this number to the oil price we think is going to happen. So they made $155 million at what price? We call that the benchmark pricing. So again, it's right here on the first or second page here, benchmark prices. So they made $155 million at this WTI price. So 70.56 USD. So I'm going to put that in there. We want to look at the heavy oil. So we have WCS heavy oil. This is now in Canadian dollars. So we need to convert this to US dollars, 71.81, which I believe is, so 56.29. That's just a simple conversion, exchange rate conversion. For NGLs, our last quarter pricing of NGLs, we don't really know because a lot of companies don't tell you what they got for the NGL for whatever reason. You'll notice this a lot. So where am I here? So basically what I do is I look for a company that has NGL pricing and kind of extrapolate off that. NGL pricing is also not that important for a lot of companies because they don't sell a lot of it, but you still want to kind of get as close as possible. Let me just see here. Yeah, they don't really give you the NGL, what they got for it. So anyway, I picked up a number online, which is $28.94 for the NGL price. So I'm going to put that in there. And usually what I like to do is I'll find a competitor to Baytex in a similar area / a similar kind of production mix and see if they'll report the NGL realization and then just go off of that. Okay. So if they made $155 million at $70 oil, how much are they going to make in the future? If we want to figure that out, we need to know what is the oil price in the future. And that's called the strip pricing. The strip pricing tells you the average WTI oil pricing or whatever oil you're using, the average pricing for it over the next 12 months. The way we calculate this is from a website called CME Group. It's some sort of exchange, I believe. So if we go to cmegroup.com, we have crude oil, futures, and options. All these links that I'm going to use today are going to be available on the website as well. If you go to whitetundra.ca, under dashboards, there's a links section, and it will give you these links to use. So this website tells you what is oil trading at for every month into the future. So if you want to sell oil in March, this is the price you're going to get. If you want to sell it in next March, that's the price you're going to get. And it goes all the way to like 2035 or something. So it's a pretty clear picture. And how we get the strip pricing is we add in the next 12 months and we divide by 12. So I've taken these next 12 months of prices and divide by 12, and we get 84.56. And you're welcome to do this calculation and check as well on that. Okay, so again, add the next 12 months and divide by 12. So you get 84.56. So that's the number I'm going to put in here, 84.56. The WCS strip pricing, which is heavy oil, Western Canadian Select. How are we going to calculate this? So I lost it here. So the CME Group also has a WCS differential pricing. So, and they have lots of other commodities and whatnot. So this gives you the differential. So Western Canadian Select is going to be trading at the WTI price for the month minus this for every month. So again, you take the next 12 months, you divide by 12, you get the average differential. It was like somewhere around $13. So I'm going to put 71.56, which is your WTI price minus your strip differential. Your strip differential, which again was these 12, the next 12 months added up and divided by 12. Okay, the NGL strip pricing, we don't really know what it is. So we're going to assume it's the same for now. If you are someone who has a better read on NGL pricing, if you know something better about WCS differentials, this spreadsheet is fully flexible. You can put in whatever number you want in here. It doesn't have to be the strip pricing. It can be, if you're trading WCS and you think it's going to tighten up to $10, feel free to put that in there. It's fully open and fully flexible to whatever numbers you want to put in there. for the strip pricing and such. So this is not a spreadsheet that you have to use my way of doing things. It's fully open. So leave it at that. Go back to the comments here. So why does the price go down over time? It doesn't always do that. That's called backwardation. So right now we are in a backwardated curve, which means that the future price is lower than the current price. What does that mean? That means that people want oil now. They don't want to wait 6 months or 12 months for the oil. They want it right now, and they're willing to pay more for it. So how can we confirm that? Because inventories are going down. So people are selling oil from inventories, and we're in a supply-demand deficit right now, where oil is being drained worldwide. What does it mean long term, or can you justify that? I don't really have any more comments on that, but you'll see that in history there's been periods of backwardation, and there's been periods of contango, which means that the price in the future is more than the current price. And the most recent example would have been in 2020, when the Cushing price went negative. You know, people were literally paying you to store oil for a month, and that's called contango. Okay. The next thing we need is the gas price. So for Baytex, it's a Canadian company. They do have some gas in the Eagle Ford as well, but it's mostly a Canadian company. So I'm gonna assume that 100% of their gas is AECO. You can put in NYMEX, you can put in other gas like Dawn or a Station 2 or whatever if you want. I'm gonna keep it simple for now, because gas is not Baytex's revenue stream. So it doesn't really matter. Again, we want to get these calculations done quick. We don't want to spend time nitpicking over little things. 10% of gas going here and there. So I'm just going to assume this for now. What was the last quarter AECO price? Again, we go into the benchmark pricing. We get an AECO price of 354 Canadian. So I'm going to put that in there. Again, we're looking for the strip gas price now. What is the gas price for the next 12 months? So that is, we can get that from, so the website is called gasalberta.com. And again, this link is on the website under links. And if you scroll to the bottom, it gives you the price for the next 12 months. Same thing, you add up the next 12 months, you divide by 12, and I believe we're somewhere around 425, or at least we were, and that's it. That's all we need to do. Once you get used to doing these, it takes less than 10 minutes to do each company. And once you have the last quarter's pricing and the strip pricing, it's going to be the same for every company. So you don't need to go and keep doing that over and over as well. Okay, there's a question here. What does AECO stand for? I honestly have no idea what AECO stands for. It's the Alberta Gas Exchange that most of the gas in Alberta trades at. So there's certain hubs for gas, AECO being one of them, Chicago, Henry Hub. We have Station 2 down in somewhere near Vancouver, I believe. So there's a lot of gas hubs. There's Waha in the Permian Basin down in Texas. So gas trades at different hubs at different prices based on the localized supply demand. So that's all I can say there. And yeah, so that's all we need. So the spreadsheet will spit out two different tables here for you. One is a free cash flow table, and one is a adjusted funds flow table. So what's free cash flow? Free cash flow tells you, again, how much money did the company make after all its expenses and after spending all capital to keep production flat or growing their production a little bit. For companies that are very, very heavy growth, you need to adjust these numbers a little bit because they're spending a lot of their free cash flow on capital as opposed to having it as a real free cash flow. So a little bit of adjustments there. And, I can kind of deal with those on a case-by-case basis. But we have annualized last quarter's free cash flow. So if you annualize how much money they made last quarter, this is the number, $642 million. And you have a free cash flow yield. The yield tells you how much percent of the enterprise value did the company generate in free cash flow. So for Baytex, it's about 14%. And what does that mean? Why is that important? So it's important because there's certain multiples that you want companies to trade at. So, some people want 6 times free cash flow. Some people want 8 times free cash flow. So what does it mean? If you have 8 times free cash flow, that means you're generating 12.5% free cash flow yield, because 1 over 8, you take 1 over the free cash flow multiple and you get the free cash flow yield. So 1 over 8, 12.5% is the free cash flow yield. So what am I looking for? When I run these companies, I'm looking for at least 12.5%. I want the company to buy back all its shares and pay back all its debt in the next 8 years, which is a roughly 12.5% yield per year. If I get 12.5% for 8 years, that's 100%. And you'll see a lot of charts on Twitter and especially with Eric Nuttall and stuff using, how many years would it take for the company to privatize and pay off all its debt? This is what he's referring to, the free cash flow yield. So why 8? Why am I using an 8 multiple? Because an 8 multiple gives me a 12.5% yield, which allows the company to give me roughly a 6% dividend and buy back roughly 5% of the shares, and another 1.5% of free cash flow is used for deleveraging or a little bit of growth. And I'm pretty happy with that in the oil industry. For a company like Baytex, which is smaller, you might want a higher yield. You might say, no, I want a 15% yield. I want a 20% yield. So it's all subjective. Again, I use 8. If you see a lot of the people on Twitter and analysts, they will use roughly an 8 multiple on this. So using the 8 multiple, we basically take the annualized free cash flow, we multiply it by 8. That's the total value of the company, the fair price value. We subtract the debt from it, and we get the fair share price. If you subtract debt, you get the market cap, the fair market cap, and you divide that by the number of shares outstanding, you get a fair share price for the company. So at last quarter's pricing, they're trading at roughly, the fair share price is roughly $6.34. At strip pricing, which is where we are today, Baytex's fair share price to me is $11.80. So it's roughly a double, about 140%, 130% increase from here. And this spreadsheet gives you the same calculation across the oil prices. So if you think oil is going to average $100 next year, the fair share price would be this. And I want to again reemphasize this. This is a relative valuation tool. So if I see Baytex at strip is roughly a double from here, a little bit more than double, and I see another company that's a 5x at strip, well, the company that's 5x is the one I'm going to do a more deeper calculation on. So just keep that in mind. This is not an absolute number that I'm telling you that Baytex is going to hit $11.80 in the next week or anything like that. It's a valuation based on a certain multiple, and then you compare companies on that multiple and which one has the most room to go up. Okay, I got some question here. So the marathon stuff, yeah. So I'll talk about these things. So there's a question here. If I'm using an 8-year multiple, I should include any projected income from future projects coming online. So correct. So Baytex has the Clearwater coming online, which is really, really good wells. So I will talk about that here in the 2022 outlook and how we adjust for that. But right now, if I'm investing, I'm going to assume that that's the cash flow they're going to generate for the next 8 years, assuming a certain oil price. For smaller companies, you might want to use a 6 multiple. For very, very risky companies, small companies, you might want to use a 4 multiple. It's all subjective. This spreadsheet only tells you the way to calculate it, and it does all the calculations for you. As far as what multiple you want to use, it's fully flexible as to what you want to use. I like 8 because that's what I think that when the generalists come in, when the funds come in, that's what I think these companies are going to trade at once they're deleveraged. And once we see that there's a structural oil bull market, I'm looking for an 8 times free cash flow multiple on some of these companies. Do they trade at that currently? No. A lot of them trade at 4 to 5 times free cash flow. So, you know, that's the valuation gap that is going to be, in my opinion, fixed. So I'll leave it at that there. Are there any questions on that, on the free cash flow calculation? If anyone wants to chat or say anything. No? Okay. So the other valuation method you can use is adjusted funds flow. So instead of looking at free cash flow, which accounts for the capital spent to keep production flat, you're worried about how much money did the company spend. There's a lot of companies that only spend money in the winter, like gas companies and such. There's companies that go heavy in Q4 based on their budgets. So if you don't want to deal with all that, you just go to adjusted funds flow, which is how much money did the company make if we don't account for the capital and all that. So I use a 4 multiple on adjusted funds flow. You will see that, again, we go back to Eric Nuttall. He posts a lot of great charts about adjusted funds flow metrics and such. So I'll reference him. And, you know, most of the time a 4 multiple is kind of what companies are trading at already. So you might want to use a 5, a 6 multiple. Again, subjective. I like using 4 just because it's a very, very conservative number. You really can't go wrong. If a company is trading below 4 times adjusted funds flow, you know, usually that's a very, very good sign. And most oil companies today are trading below 4 times adjusted funds flow. So again, you have a fair share price at a variety of oil projected prices. When people say that, you know, Baytex is currently valuing a $70 oil price, that's why they're saying this, because the fair share price of Baytex is roughly at an 8 times multiple at $70. So that's how they're calculating and saying, hey, you know, Baytex is valued at $65 or Cenovus is valued at you know, $72 or whatever number that people reference. And the other important point here is look at when the fair share price goes into the negative. So somewhere between $60 and $50, the fair share price of Baytex goes from a positive number to a negative number. That's important because it tells you that below about $55 oil, this company's shares are basically worthless. So below that, you want to be really careful owning this company, but also it gives you a very good opportunity if you think that oil will trade above that number. And that's why a lot of people on this call and a lot of people who I believe have reached out to me bought these stocks because they were literally worthless according to the calculation. But as the price went up, they started gaining a lot of value and becoming you know, very, very valuable shares. So I'll leave it at that. There's a question here. In prior bull markets, what FCF multiples were E&Ps trading at? So this is something I don't know. It's very hard to track because you have to get the free cash flow every quarter for each company and kind of run calculations that way. So I don't have an idea for you right now, but I would think it's somewhere around 8x. And if someone else has any comments on that, please chime in. Someone who's actually done that calculation, and I hope I have time to do that here one of these days and get you an answer, because that is something that people have asked me a couple of times now. Just give me a sec. I'm going to connect the laptop to the battery.
Well, while Shubham's doing that, I'm just going to quickly step in and just say, if anybody not be able to join in, the link is on Shubham's website. Click on the Zoom, and then we get the visuals, and you can operate in the spreadsheet. This like to incentivize you guys to sucker you into this full on experience. But if you're just fine like this, we'll go back and
yes. Right on. Yeah. Thank you for sure. Yes. So anyone who joined late and you're looking for this spreadsheet, it's on the website, whitetundra.ca. At the bottom there, Excel seminar Excel or something it's called. So grab it from there and you can follow along. Can you hear me now?
Yes.
Okay, cool. Okay. Cool. So, okay. So this is what the company generates in the future. We know that. We've calculated that, but that is unhedged. That is fully unhedged. We need to account for the hedging because Baytex has hedged a bunch of oil for the next, for Q4 of last year and then into 2022. And that is going to affect this cash flow. Like, this cash flow is not what they're actually going to generate. Remember, we unaccounted for the hedging situation. Now we have to account for the real hedging in the future, because this hedging was for Q3, which is done. Hedges are different every quarter. We'll put the actual hedging now into here. So how do we get that? Well, I'm going to look for the Baytex December presentation, which may not be available anymore, but if you have access to it, or I can send you this for whoever's looking for this. And basically, we want to go into their hedging. Where is the hedging? So right here is the slide we're looking for. So it gives you the hedging for Q4 and it gives you the hedging for 2022. So I just want to say that we did have a kind of a hijack attack once on this Zoom. So please don't make your name as Zoom user or iPhone, because I am a little wary of adding people with names like that. So yeah, so if you are joining the Zoom call, just use, if you don't want to use your real name, at least use some sort of fake name, because this Zoom user, I'm a little wary of. Yes. Yes. So yes. So on the hedges, okay, now I can explain these a little bit more. So the fixed hedges are the swaps. They will get exactly $45 US for 4,000 barrels. These are our three-way options. The three-way options tells you that this is the minimum price you're going to get, and this is the maximum price you're going to get, between 35 and 52. If the price of oil is between that, there's a bunch of complex calculations that can determine what they're actually going to get. It's actually nice and easy for us because the price of oil is over 52. So that's the max you're going to get anyway. So you take 4,000 barrels at $45, you take 17.5 at $52, and you average it out to a number. And then we'll do the same for 2022. There's 10,000 barrels at this price, and there's 10,000 barrels at $68. Average it out. So I'm going to let you do the calculation, but this is what we come up with. So for Q4, it's 21,000 barrels at $58 Canadian, again, all in Canadian, and the rest of it. And this is just simple averaging. So you take 4,000 multiplied by this, plus 17,000 multiplied by this, and you divide it by the total barrels to get an averaging on that. And this is what I get. So what this tells me is that in Q4, they're going to lose $60 million at strip or at Q3 pricing on their hedges. And for the next year, they're going to lose about $123 million. And if the price oil goes to 100, that's what their hedging loss is going to be, you know, et cetera, et cetera. And we have the new table, which gives us the free cash flow yields and the free cash flow valuations and the fair share prices on a hedged situation, the actual hedges moving forward. So the actual hedges for Q4 and 2022 affect the cash flow by this much, and we get this pricing, this fair share calculation at the end of the day. So where are we here? So on strip pricing, using an 8 times free cash flow multiple, Baytex is valued at $8.18. So you're looking at roughly a 50 to 60% gain from where we are right now. If Baytex gets to an 8 times multiple, is that good? Is that bad? We don't know. We have to compare it to the other companies in our kind of mandate, you know, whatever companies you want to compare it with. And if you want to go back, I think I've covered about 15 to 20 companies in the previous sessions, and you can kind of compare the premiums and where things are trading that way, or you can run your own calculations and compare them that way. But to go back to what I do, I'll run these Excel spreadsheets on the 57 companies that I'm tracking in the Canadian oil and gas space, and I'll take the estimated share price, fair share price at strip pricing. I'll divide that by the current share price for each company, and that gives me how much upside do I have. Okay, and then I'll look across the entire portfolio of the 57 corporations, and I'll pick the top 5 or 7 or 10 or how much ever time I have, and I'll dive deeper into them. I'll look at operational performance, well results, management, their record, their track record on drilling, etc. But if the company does not generate the free cash flow I need, why should I spend time, looking into these things if it really doesn't, doesn't help me anyway? Okay. So there's a couple questions. Why are we still using three-way options? Good question, and one that I have had a lot, that companies have lost a lot of money hedging in 2020 and 2021. So why do they keep using these three-way options? Especially now that they're deleveraged and they have some money to spend. I don't know. I think the premiums are just too high on two-way collars. That's what I was told anyway, that they're not just slightly more expensive, they're very, very more expensive. Sorry. So I'll leave it at that. How to model in debt reduction. So the debt reduction will be modeled in here in the 2022 outlook that I'm going to do, and you will see the results of that. Generally speaking, should we be focused on non-hedged companies? Yeah, you're correct. Non-hedged companies will make more money, but I'll tell you what, there's been a couple of great opportunities that I've got here and I'm still invested in, where companies had absolutely poor hedging for Q3 and Q4, and then come 2022, the hedges were way better, and the market just ignored that because they were using cash flow multiples on their Q3 results, their hedged Q3 results, not realizing that the company goes from a money loser to a huge money creator because their hedges drop off. So, I think it's important to look at all companies because you will identify opportunities where the market is ignoring companies because they haven't done the work on looking at how the hedging situation has changed. Seems like really tough hedges. Yes, a lot of these hedges were due to the banks, they were due to the debt holders, they were due to other restrictions and covenants. Whoever took a BDC loan in Canada was highly restricted on their hedging. So yeah, some of it was forced, but at the same time, they still lost money. So you can't argue against that, that basic fact. How to model for ARO. I don't have a model here for ARO. I personally don't think it's important. There's people who will absolutely argue against me and slap me for saying something like that. But I really don't think that ARO is that big a deal. I think companies are spending a lot of money on it already. There's a lot of provincial grants for it, a lot of support, and there's no company out there that's suddenly going to have a huge ARO liability all at once come due. It's a slow and steady process, and in a $80, $90, $100 oil environment, it just is not important to me. Unless the company is going into bankruptcy and I'm worried about my share value and such, I really don't take it into account. In fact, I like companies with high ARO because people model them the wrong way. They treat ARO as if it's a debt, a full debt, which you know, I'm happy to take companies like that if they're going to be valued very, very cheaply and enjoy the ride up. So I'll leave it at that. So great point on hedges. Yeah, I think the hedge book is extremely important. Companies have lost so much money in hedging at certain times, and they've gained a lot of money in hedging at certain times. So if you can find that inflection point and kind of invest accordingly, you can do really good and find very good deals where the market just has not done the work. And I will assure you that people don't do the work in oil and gas companies. They just they pick price to earnings and all this other stuff online off Google, and it's totally wrong. The wrong way to value these companies, in my opinion. So if you put in a little bit of work, you look at the hedging structure, you look at the actual cash flow generation, you can find really, really good gems in there. Could you give a few examples of companies whose hedges come off in 2022? So I will discuss the next one here. Surge Energy was one of them. Spartan Delta is one where all their hedges come off on the condensate at the end of June 2022. Arc Resources has a lot of hedging coming off. Meg Energy, highly hedged. They had about 30% production hedged at $46. That's becoming completely unhedged in 2022. So, you know, think about that. That's an extra $40 Canadian a barrel on 30,000 barrels. So, you know, that's about $500 million a year of hedging loss that they had in 2022. Or in 2021, that's now going to become free cash flow. And people are still using the same old tired valuations. You know, without taking hedging into account, you're not really getting the full picture. And it's almost been a boon because I've been able to find companies like Meg who are just totally undervalued when you compare them on an unhedged structure, which they are. I guess you don't factor in ARO as debt. No, I don't believe that's the right way to do it. A lot of analysts do, and I think they get the valuations completely wrong. They've missed out on a lot of high-flying, high-torque names because of this. You know, just because Obsidian has 500 million of ARO doesn't mean it's gonna be due today. It only matters in bankruptcy proceedings. It matters if the share price starts going down and people are worried about this liability. I don't think that's the right way to value ARO. Even if you're using some sort of discounted model, I don't think it's a debt. It's there's many ways to get around it, and you know, I will in the future, if the AER really clamps down on it, maybe, but not at the moment. Price to earnings is useless in E&Ps. I couldn't agree more. As soon as somebody starts talking about EPS, earnings per share, or price to earnings ratios in oil and gas, yeah, I can give you some examples where companies made 10 times their share price value in earnings and it didn't do anything. The share price went down after that. So anyone talking about that, I don't think it's the right metric to use. Cardinal has no hedges, correct. Mag has no energy hedges, correct. Journey is another one. Meg is completely unhedged for 2022, the entire 2022. So it's not Q2, it's entire 2022. It's Spartan Delta, where the June 30th, their condensate hedges come off. Banks have been getting worried about ARO, it says, since Redwater. Agreed. Yeah, it is a big problem, but only at low oil prices, and adding it to debt all of a sudden, all at once, is definitely not the right way to be valuing these companies. Just my opinion, I should say that. That's not a fact. That's just my what I think. Okay, so Baytex has no gas hedges, so I'm going to continue on. This is what they got here. Wow, lots of questions today. This is pretty amazing. Do I ever calculate net asset value? Yes. So I haven't so far, because the 2020 reserve reports are totally meaningless. They use a strip pricing of $46 or $52 a barrel, which we know is not correct. So I'm waiting for the 2021 annual reports to come out, and I can get some 1P reserve NAVs, 2P reserve NAVs, and kind of go off that. But until now, I haven't done any calculations because I don't have the data, and I don't think anyone here can guess reserve reports. It's a multi-billion-dollar industry for a reason. How to calculate capital efficiency per barrel and full cycle cost. Okay, very nice. So what I would do is you take your production and you take the decline rate. So if Baytex tells you their decline rate is about 20%, you take 20% of this, so about 16,000 barrels, and you take how much capital they spend to stay flat, and you divide the capital. You'll divide the capital by that number of BOEs, and that tells you how much money does Baytex require per barrel to bring that into production and to keep their production flat. So that gives you the capital efficiency per barrel. Full cycle cost. That's a hard one. There's no real way to calculate full cycle cost. It's very, very nuanced, and every company is going to be different, depending on what they bought the land for, what their D&C costs are, what their decline rate is, their interest cost, their G&A cost. It's just a very hard question. And definitely don't believe what the shale company presentations are telling you. So I'll leave it at that. There's no easy way to calculate it, and people usually underestimate them by a lot. Is my preference to keep it to cash flow? Yeah. So for now, I'm doing only cash flow calculations because there's such a big emphasis on dividends and share buybacks and debt deleveraging all of a sudden, that's the metric that people are going to be looking at. How much share buybacks can you do? How much dividend can you give out? And the net asset value has nothing to do with that. It's all cash flow and free cash flow. Okay, so just to come back to this, so we have our fair share price value at strip, at 80, at 90, etc. I run I run this for all 57 companies. If you are tracking more companies, if you want to use this for gold or silver or copper or whatever, feel free. And I look at the relative upside, and I pick the top 5, 7, 10 companies and do a deeper dive. So I just want to keep re-emphasizing that, because this is not, I'm not telling you this is what the share price is worth tomorrow. It's a relative valuation tool. Okay. Production growth in Q4. So Baytex is not guiding for any production growth in Q4, so I'm going to leave that at 0. If there are companies that, like Headwater, for example, Ngl, I think, is another one, that are guiding for it, you want to put that in here, and put that in there. So now let's calculate the Q4. What's happening in Q4 for Baytex? we need the Q4 pricing for WTI. And we can get that from this website, EIA.gov, the US Energy Information Administration. They give you the actual WTI price for every month. So October, November, December, that's Q4. We will take these three numbers, add them up, divide by 3. Simple math, 77.45. We do the same for WCS oil prices. This is the economic dashboard of Alberta. It gives you the WCS for October, November, December. Take the last 3 months, add them up, divide by 3. That gives the average price for Q4. So same, everything is the same. So I'm just going to copy them because I already calculated these. Okay, growth netback is 0. The Q4 NGL pricing, again, this is more of a guess. What I use is ARC Energy Institute has these great charts that they update every week. And it tells you the NGL pricing as a function of Edmonton Light, as a percentage of Edmonton Light pricing. So, you know, Q4 was a little bit higher. We had the spike where butanes were selling for 90%, the same as oil. Propanes that spiked up. So, you know, if the Q3 price was $29, you know, I would say we see a significant upward curve in this graph. So, you know, let's say $40 US. Again, you can put in whatever number you want. If you have actual data on what Baytex got, feel free to put that in there. Q4 AECO gas price. This is a number that we don't have. So how are we going to get it? We look for a company that has reported Q4 results. And the best one right now is Suncor. They give you the AECO natural gas price for Q4 was $4.70. So that's what I put in there. Is everyone following along? Is there any questions on the valuation, where I'm getting the numbers, anything like that at all? No, cool. Okay, so we have a Q4 adjusted funds flow projection and we have a Q4 free cash flow projection. That is including the hedging loss. So they're going to lose $60 million in hedging in Q4, and including the hedging loss, this is what I project. Once Baytex's Q4 results actually come out, I will come back and compare to this. And if they're significantly off, I will need to find what the problem is, because I might be misunderstanding something, I might be misrepresenting something and losing out on an opportunity. So if Baytex's Q4 free cash flow comes in at $300 million, you know, there's something wrong with my valuation. Maybe I got the wrong hedges in there, you know, XYZ. So I always come back and compare, you know, just so I can kind of stress test my own spreadsheet. I can see whether prices have kind of diverted somewhere. Has Baytex saved a lot of money on operating costs all of a sudden that was unexpected and maybe is a future boon for 2022? So always come back and check against these numbers. And again, I run these for all the companies, and you know, that's why earnings season is of particular importance to me. And I really need to make sure that everything is bang on. You know, things are making sense, because earnings season is when you can really identify which companies have somehow changed their cost structure. Have they suddenly saved a lot of money on operating costs? Have they saved a lot of money on G&A all of a sudden? Have they reduced their interest costs a lot? And the market has completely failed to understand that. Have their hedges come down a lot and the market has failed to understand that? So, you know, this month or so is very important, and to try and get these done earlier to that. Okay, so there's a question here. Can you differentiate FFO from CFO, notably due to non-cash working capital changes? Notably due to non-cash working capital changes. So yeah, there's a lot of one-time items that can kind of affect these numbers here and there. Generally, I don't find it to be that important. To be honest with you, I have not found many cases, or any that I can even remember right now, when it really affected the calculations on a material basis. So there's things like acquisitions and divestments that you really need to be careful with, which I will discuss here with Surge and Pinecliff, because they both had acquisitions. But you're right, for the most part, they kind of don't really make a difference materially anyways, maybe $5 million here, etc. So I'll leave it at that. So no dividend, no buybacks. So there's nothing else going on with Baytex in Q4. So we have our, this $157 million was applied to pay back debt. So the EV goes down, the enterprise value goes down because they've paid back a bunch of debt. What's the production growth in 2022? So we have Baytex's 2022 budget. They're guiding for 80 to 83,000. So let's take the midpoint of that, 81.5. We were at 79.8 in Q3. So 81.5 is roughly 1,600 more BOEs a day. So that's their production growth. What's their growth netback? So how much money are they making on this growth? So we'll go here. We look for our netback for Q3. I usually like to use the operating netback, because if Baytex grows production, their G&A costs shouldn't go up. They shouldn't need to add a bunch of employees. Their cash financing costs shouldn't go up because they're not adding any debt. So so we'll use this operating netback of $39. Quick and dirty calculation. That gives you the projected adjusted funds flow for 2022 at strip pricing. What's their 2022 capital? I just closed that sheet here. Okay, right on. Cool. So, okay, operating netback. Everyone can still hear me? Yes? And the screen is still sharing?
Yeah, Roger.
Yeah, you're good.
Okay, so for the netback, we want to use the operating netback for Q3, because if Baytex is growing production by about 2%, I don't expect that their G&A cost is going to go up. I don't think they need to employ any significant amount of extra people. Their cash financing costs shouldn't go up because they're not taking on any debt. So the operating netback is a pretty quick and dirty kind of number that works. So netback, and we look at the operating netback, $39. So I threw that in here as a growth netback. Okay, and then what's their capital program for 2022? Because companies spend different money year to year, a lot of companies had lowered budgets for 2021. So we want to look at the actual, where did it go? The actual, right here. So the 2022 budget for Baytex, they say it's between $400 to $450 million. So we'll take the midpoint of that. We'll take 425 and we'll put that in there. And that's what we get. They are going to generate roughly 1.46 billion of adjusted funds flow in 2022 at strip pricing. They're going to spend 425 of that on capital. They're going to lose $256 million on hedging, and their free cash flow will be $780 million. Are there any other projected free cash flow sources? I think there will be, because they will pay back some debt. So let's say they pay back $500 million of debt at 4%. So 20 million, let's say, is an extra that they're getting. Just give me a sec here. Set this up. Okay. So the projected free cash flow yield at strip for 2022 is 18.4%. again, I look for 12.5%. If I'm getting 18.4, I'll compare this to the other 56 companies that I have, and I'll see where things go from there. Yeah, okay. So there's questions here on the ARO talk. ARO should be considered for companies that are small caps that have lots of ARO. Yes, the ARO should not be ignored, yes, but it should also not be treated like a boogeyman either, because you can actually find really good deals, as Scott mentions here. So thanks for that comment. Netback might actually increase if you divide your fixed cost by higher production. Correct. The netback could increase by a couple dollars because you're making more production for the same amount of fixed costs. Again, this is a very flexible spreadsheet. You can put in whatever you want in here. So like for example, Sharif, who you've worked in the industry and maybe some of these things, for sure you can maybe add a couple of dollars here. It doesn't affect the final calculation really that much. It adds $1 million if you add $2 there. But okay, so that's what we have. So it's about $780 million at 85 roughly is a strip. So let's go back to Baytex's new corporate presentation. At 2022, at $85, which is kind of the strip price now, they're projecting roughly just over $600 million here. Yeah, for 2022. We came up with 780 plus this extra 20, so $800 million. So where is the disconnect? We don't know where the disconnect is right now. We're waiting for them to release their Q4 results, and we will wait for them to release their Q1 results and then stress test this against that model, because they might be using a different WCS differential. They might be using a different NGL pricing. They might be using a gas pricing that is not accurate. Like they're using $3.50 for AECO gas when AECO gas is actually right now at $4.70. So some of these things will affect our calculation compared to what management's putting out, because again, management is putting it out at a point in time at a certain price. So, who will end up being correct? Well, we don't know, but you always want to check as to why your numbers are different. So, we know a little bit of that is because of the gas pricing, the NGL pricing might be different, the WCS differential might be different, and then we'll just follow along. I'll follow this throughout the year. I'll see if this changes very much from what they're projecting, and maybe it's when you reach out to management. You say, look, this is what my calculations are saying. Can you explain this loss? And I hate to rag on a company, but a company like Athabasca is absolutely notorious for losing money when the calculations say otherwise. So, something like that, you really want to check and make sure that your numbers actually are what management is actually thinking. And if not, why is there a significant difference if you do find one? So 2022, I'm assuming they're not going to pay a dividend. They're not going to do buybacks, XYZ. So we get our 2022 E net debt. And why is that important? Because a lot of charts you see now, they're talking about 2022 E, which means the end of 2022. So when you're comparing your free cash flow yields to charts like this, you need your numbers to be end of 2022. And this spreadsheet does it for you. That Baytex doesn't have preferred shares. And then you have 2023. They're going to save another 30 million on interest, let's say. So that's the free cash flow yield for 2023, if you want to look that far into the future. And that's it. I do this exact same thing for all the companies. I'll compare the numbers, and I'll pick my top 5 or 7 or 10 and do the deeper dives and potentially invest in them. So does that make sense to everyone? Is there any questions on Baytex before I go into kind of sharing some of my thoughts as to what Baytex has that's a little special, I think, and why it might be worth considering, even though the free cash flow yields are a little bit lower. So Baytex has kind of three properties that I'm watching closely. The Clearwater, obviously, everyone knows the Clearwater has performed substantially. Some of their Peavine Clearwater wells are absolutely phenomenal. You know, Steve McCaffrey on Twitter puts out these reports monthly. Great guy to follow. And I just track the wells, how they're doing over time. Are they losing a bunch of production? Are they doing well? This blue well here, like for example, it fell off a cliff. So I followed up on this and realized that this well is shut in, I guess, because they're drilling another well or fracking, or sorry, not fracking, but drilling another well on this pad. So, you know, you want to follow along these wells because this is a big play for Baytex. And if they continue to outperform here, you know, these wells make a lot of money. So it's something that's a catalyst and a potential free cash flow machine going forward. Let's go to the Eagle Ford. Baytex's Eagle Ford is right here. They have a JV with Marathon, which has the second best wells in the Eagle Ford, mostly in the Karnes County. They have very good Eagle Ford acreage. The rest of the Eagle Ford is basically trash. It's condensate production with the high gas rates and, you know, pretty poor wells. But Baytex has some of the best acreage in this area. So this is very important because look how much better their acreage is compared to some of the other bigger players here. You know, ConocoPhillips has the best, but Marathon and Baytex are not far behind. And then you have EOG with their double premium, which is obviously not double premium, more like junk. And then you have Chesapeake, which is, I don't think I need to say more except say that it's Chesapeake in the Eagle Ford. So, you know, Baytex has pretty decent properties in the Clearwater and the Eagle Ford. Now let's go to the East Duvernay, which is a upcoming kind of field. A lot of companies have tried producing here. There's a couple private companies, Vesta and Artis, that are heavy here. Crescent Point bought up a bunch of acreage, and then they basically let it expire, as far as I know. Baytex got a bunch of acreage through the Raging River deal. Journey and Kewadanock drilled a couple wells that were, you know, pretty decent. And look what Baytex is doing here. Their wells are by far outperforming the Crescent Point wells, the Tyne wells, the Bonavista wells, you know, the Vesta and Artis private wells. And they're doing a pretty fine job here at this East Duvernay. And this is a completely unexplored area. There's a lot of acreage here where they can go in and they can basically make this the new Kaybob. If they can prove out the wells, if they can make them very economic. The East Duvernay has no problems with year-round access. The roads are much nicer. The roads are much more flatter, as opposed to somebody who's worked in the Kaybob. Like it's just a mess there to get anywhere. You're deep in the bush, in the swamp. So, you know, the fact that Baytex is doing really well here is something to watch for, because again, this is a very high growth area where there's a lot of open land. They can really make this one of their core areas if they can prove out the land. I don't have the decline rates or the ultimate EURs on them. This is just the calendar daily production, I believe, for IP90, I believe these are. So again, it's an emerging play, but if Baytex is doing so much better than Crescent Point and Tyne and Vesta and Artis, that's something to watch for. It's still early yet. They've only drilled, I think, 2 or 3 wells. So it's still early, but you don't make money in the oil and gas industry by waiting till all the data is out there, because by then everyone else is already in these names. So if you think they can repeat these results, I think they're drilling 2 more wells in 2022. If you think their Eagle Ford acreage will keep performing, and they have this Clearwater extra catalyst of making a bunch of money here, you know, that's a pretty good sign for a production beat, and that's a pretty good sign for a lot of extra inventory, a lot of extra reserves, and the net asset value goes up, the free cash flow goes up. So, you know, Baytex is pretty richly valued, in my opinion, on a cash flow generation perspective, but they have these couple of catalysts, which I think can definitely add a lot of value going forward. So I'm watching these closely. I like to track these East Duvernay wells anyway. I like to track these Clearwater wells and how they're doing. So, you know, Eagleford, I don't have as much open access to, but you know, still, these are pretty good results. So I'll leave it at that. Is there any questions on Baytex in specific, or anyone on the chat who wants to say something else? No. Okay. Where do I get this data on well performance? So Petra Ninja is your best tool. It's free, and the data is a little bit delayed, but you get the data, and it's available for you. You need the exact well coordinates. So I go to boereport.com. There's a well activity map there that tells you which company has drilled which wells over the last, you know, you can pick 3 months, you can pick 6 months, whatever. And then I'll go and track these wells and see how they're doing, you know, every so often. For anything that's a Clearwater multi-leg horizontal, Steve here does a really fantastic job at this. So I just kind of trust him with building these graphs out and following along with his stuff. Okay, so was the leverage debt the main reason why Baytex has such a hard fall? I think every company had a hard fall in the recent oil price collapse. So, you know, we can't really single out Baytex on that. Baytex used to be in the $30 range. Yes. Keep in mind that Baytex now has doubled the share count that they did as it did then, because they bought Raging River using shares, and they doubled the share count. So if Baytex is going to go back into the $30 range, the value of the company is going to be double now. So just keep that in mind. You can't just compare share prices from before unless you account for the number of shares outstanding. Your options sheet is amazing. So thank you for that. I don't really want to talk about my options right now. I have a seminar coming up in 2 weeks, going through every single option I own and why I owned it, and the results of it. So I'll defer to that. There's a question here. Does anybody think Baytax Eagleford is going to decline significantly because there's only 13 wells coming online? Potentially, yes, but the Eagleford wells have a huge decline rate. I think it's like 80% in the first year. So you might be spot on. I haven't looked into Baytex that deeply. So if you want to share some more on that, feel free to chime in on the chat or on the mic. When does Baytex report? I don't know right now off the top of my head. Another catalyst is a relisting on the New York Stock Exchange. Yes, so I haven't heard any confirmation on that, but yeah, potentially that could be the case. Slightly off topic. Yeah, so the Iran oil news, there's been a lot of people asking for this. So there was about a 7-hour conversation yesterday on Twitter Spaces. So I would recommend you listen to that. And also, if you listen to my macro outlook, the January 25th version, or sorry, January 22nd version, I believe, on my website, I share a lot of Iranian data and my thoughts on the condensate exports, their floating storage, their current production, their current exports. So you can kind of get an idea of that on there. There is no weekend oil pricing. No, the exchanges don't trade over the weekend, as far as I understand, especially not WTI or WCS for that matter. Cool. Okay. We'll continue on then. So we'll do the same now for Surge Energy, which is, I think people know, is one of my biggest holdings. It has been since about June or July, and then I really bought in with conviction in July, August. ish. It's been struggling a bit because of some deals they've made, a bunch of debt financing and stuff. So there's a lot of noise around the stock, but it's one that I'll kind of here go through and explain why I like it so much. So exact same, nothing changes. We use the exact same calculations. I'll close that, okay. So production, again, this is the Surge Energy MD&A, the management discussion and analysis is what you're looking for. Production 17,642. So we'll throw that in there. Liquids percentage, they don't break it down for you, but it's about 84%. And the way you would calculate that is you take all your oils and NGLs, so these two, and you divide them by the total BOEs, yeah, and you get your liquids percentage. Okay, so Baytex is kind of a mix of light and heavy oils. I'm going to throw it in the light oil section for now, because most of it is light, Southeast Saskatchewan especially. So I'm going to go with that for now. NGLs, throw that in there. Number of shares outstanding. Okay. The number of shares outstanding in the Q3 report is going to be wrong because they made an acquisition. So we need the latest number of shares outstanding, which if you go to their newest corporate presentation, tells you right there, 83.4 million. I believe the price closed at 662, 664. The net debt, so if you take their, oh, sorry, where am I? The net debt end of period right here, about $320 million. So I'm gonna throw that in there. Again, we're looking for net debt, not current debt, net debt. So this is a little bit mislabeled here, and I will fix that. Debt to EV ratio, very similar to Baytax. So again, I'm not really concerned about it right now. So I'm going to leave these blank here. They don't pay a dividend. Last quarter's adjusted funds flow. That is adjusted funds flow right here, $28 million. So put that in there. Last quarter's free cash flow. So this is Q3 again. So some companies don't put free cash flow in there, you know, as an open kind of metric that they say. So free cash flow is adjusted funds flow, 28, minus your CapEx, capital expenditures, which is 34. So 28 minus 34, we get -6. So Surge actually lost money in Q3. After keeping their production flat, they actually lost money. They went more in debt, even though oil price was about $70. So, you know, some people might look at this, especially people, you know, who maybe don't understand the company, they don't want to put in the work, and they say, oh, this is a garbage company. Like, you know, why would I buy something that's losing money at $70 oil? Agreed. Why would you? Well, because if you do the work, there's other factors that change it. So I'll just go through here the spreadsheet quick. So the hedging impact for last quarter, realized. So we have, where is it? Right here. Realized loss on commodity contracts, $23 million. They lost $23 million in Q3 just on the hedging. So big loss, absolutely bad hedges that lost a ton of money. So when you take that into account, they were actually free cash flow positive. But you know, if somebody just looked at the first two numbers and they said, you know, they didn't do any deeper dive into it, well, you never realize this. So share buyback was 0. These pricings I will just copy because it's the same. Q3 pricing and strip pricing. I'll put that in there. Do they release benchmark? Yeah, so they don't release NGL pricing either, unfortunately. So we they have an oil and NGL. They have an NGL pricing actually right here, $50.31 a barrel. So we'll let's put the actual number in. So that's 50 Canadian to USD. So about 39.44 is what they got for their NGLs. You know, we saw that the strip was a little bit higher based on the ARC Energy report, so we'll go 45 for the strip. Yeah, even though that's not really accurate, but I believe that I'll say 100% of their gas was AECO as well, because Surge again operates in mostly in Canada. The last quarter price and the projected price, same. Okay, and that's it, you're done. It took less than 5 minutes to do this whole thing for the company. So the exact same calculations, we see that, you know, at strip pricing, you're looking at roughly a double again, maybe less than a double actually. So, you know, a little bit less, yeah, a little bit less torque than Baytex unhedged. Adjusted funds flow chart, it's the exact same metrics and valuations and calculations. Nothing really changes here. So, okay, we want to adjust for hedging. So again, we look for a older corporate presentation. We have Q4 hedging, Q1 hedging. You don't want to use this oil hedging table because this gives you the floor price. We need the ceiling price. We need what are they actually getting on the hedges, not the floor price. So sometimes, unfortunately, you have to go in and calculate things a little bit manually because the hedging can actually make a very significant difference, as I showed you earlier in Q3 with Surge. So when I added all these numbers up, which is again simple averaging, so they're selling this many barrels at this price, this many barrels at this price, and 250 barrels at this price. You add them up and you divide them by the total barrels, and you will get this here. So we account for hedging. So they're going to lose this much money in Q4. That's what they're going to lose in the next year. So, you know, not looking very good. Like this company is actually overvalued at strip when you look at the current hedging situation. So it currently trades at 664. The spreadsheet is telling us it's only worth 379. You know, so not looking good for Surge, not looking good for my investment so far. But what we failed to include was that Surge did a couple acquisitions in Q3. So there's some production growth that's going to come online here for Q4. So let's just talk about that here. So they bought these Astra assets, and this transaction closed in it closed in mid-August of 2021, so about halfway through Q3, and the total barrels was 4,100. So if it closed halfway through Q3, about half of this has been already taken into account in the Q3 results, and about half of it isn't. So there's an extra 2,050 barrels that's going to be in a Q4 growth because they acquired these. Also, they acquired FireSky. FireSky was roughly 1,500 barrels. So 2,050 plus 1,500, we get 3,550 barrels of additional production for Q4. What's the netback on this? So before somebody kind of goes on this, the FireSky deal didn't exactly close early in Q4, but for the sake of simple calculation, I'm just going to assume it did and take it into account. It's not a huge part of their production, so we'll take it as that. Okay, so what's the netbacks for Surge in Q4? So on the Astra deal, they say it's $42 at 65 WTI pricing. Q4 pricing was roughly $77. So let's add in another 15 Canadian to the WTI price. So between $77 WTI and 65 WTI, that's 12 US, which is roughly 15 Canadian. So we'll add 15 Canadian to the netback, so it's about $57. The Fire Sky deal, it was $52 at 70 WTI. So we get to the same number. We get roughly $57, $58 net back on the new production. The Q4 pricing, again, it's the exact same. It shouldn't change from company to company. So I'm just going to throw that in there as is. So Q4, after hedging, they're going to make roughly $27 million. Is my kind of prediction, what the spreadsheet is telling us. These are all zero. There's no dividend, there's no buyback or anything like that. So, okay, there's no preferred shares. Okay, so we have that. Now, 2022, what's happening in 2022? So they had roughly 17.6 thousand production in Q3. We added roughly 3,500. So that puts us to about 21,000. And when we look at what management is guiding for, they are guiding for 21,500. So there's an extra 500 that they're going to add. And I also think, and this is just my own prediction, is that because of their exceptional results in the Sparky, because of their exceptional results in Southeast Saskatchewan, and because I know management has told me this, that they're actually at more than 22,000 barrels a day currently already. So there's about an extra 1,000 barrels of additional production that's going to come online in 2022. What's the net back on that? 2022, the strip pricing is another $6 more than the Q4 pricing. $6 converted to Canadian dollars, let's say $8, and add that to the net back. So 58 plus 8 is 66. Does everyone kind of follow along with that? Is that making sense? How I did that calculation? Yeah. So if the net back is $58 at 77 WTI, and the current strip is 84.5, we just adjust that up accordingly. What's their 2022 capital program? It's about 124 million. They tell you that right there. So we're going to throw that in there, 124. And other free cash flow sources in 22. Again, I think they pay back some debt. So let's say they pay back $50 million of debt at 4%. Surge's debt is a little bit higher, about 6%. So, that's about $3 million, let's say. And look at what you end up with. You end up with a projected free cash flow for 2022. Where is it? Of 25%, and then Baytex was at 18%. So even though Baytex was looking very, very good here, and Surge was looking like absolute hot garbage based on their hedging numbers, when you put the numbers in for 2022 and the production growth that they are going to happen, that is going to happen, their acquisitions, when you account for that, the free cash flow yield actually becomes better on a relative basis. And again, I'm not saying one stock is better than the other. This is not a recommendation of any sort. It's just the calculations that I do. If you want to say, Surge is not going to actually be 22,000 barrels, they're only going to be 21.5, then you only put 500 of a growth here, and the whole thing adjusts accordingly. If you think they're going to add 100 employees for some reason and the net back goes down to $50, you put that in, and the spreadsheet adjusts accordingly. So it's very flexible. This is my opinion, and kind of one of the reasons that Surge is very, very exciting to me, because not only do I have this, if I go into hang on, let me just fill these in. So nothing happens here. They'll get another $5 million from interest savings, let's say. So that's the 2023 yield. And a little bit of insight again as to why these Macklin Sparky wells, there is a recorded Twitter Spaces on this, about 2.5 hours long. So if you're looking for more information on this, I also have a Twitter thread on this. These wells are outperforming massively. they're producing about 3 to 5 times what the previous wells did because they're using oil-based drilling mud and they're using multi-leg horizontal technology that Baytex has proven out in the Clearwater. Surge has brought that into the Sparky now and is doing exceptionally well with these. The wells paid out in 115 days, so less than 4-month payout. This is the latest data that I have. The wells are performing very nicely. And look at the Sparky, and look at Surge's land position in the Sparky. This Macklin Wells is this little piece right here, where they've converted about 40 locations that were tier C to a tier 1 location. So now extrapolate that to this entire Sparky pool. They're not all going to show the same results in increase in production. They're not all going to get that much better. However, the land position itself gives it a huge kind of catalyst again, that if they can prove out one of these chunks here with a few wells, they can sell this little pool, or they can make a lot of money from this pool, add cash flow, etc. This is Surge's Southeast Saskatchewan position. Again, very, very economic. Their latest 2 wells paid out in less than 55 days. That's unheard of. Less than 2 months for these wells to pay out. And money in the bank, and everything that comes in after this is extra free cash flow. And look at their position in Southeast Saskatchewan as well. They allowed Astra and Farsky to de-risk these positions, to find where the oil is, to find the inventory, and then bought them out. And now they sit on this inventory for 2022, 2023, and drilling where they know there's oil. They know they're going to hit good results. It's never guaranteed, but it's de-risked. And they're laughing all the way to the bank. So this is one company where a lot of people, especially in November, December, were looking at it and they said, well, this is not really making money. The hedges suck and all this. Well, if you look past the Q4 hedges, which were very, very bad, and the Q3 hedges, we still have a lot of hedges, but they're not as bad, and the cash flow changes a lot. How does the royalty rate affect things? I don't really have an answer for you on that. I think I should have mentioned this earlier, but anything that affects all the companies in the oil patch the same, if we just ignore it, we end up at the same endpoint, right? Like if a certain company has 8% royalty and so do the rest of them, does it really affect the final valuation that we're getting at? Not materially. There are some companies that pay more royalties, yes. It's more of a problem in the oil sands. For conventional fields, it's pretty status quo across the fields. Have the improvements been reflected in the Q3 results? I don't know what you're asking, but okay, yeah. So none of these multi-leg wells were on really until October, November. So no, this extra oil that they got from this multi-leg wells really is going to make an impact in Q4, not in Q3 results. Is the whole area inside the line all their acreage? No. So this whole area is the entire Sparky play. The rectangular boxes.
String analysis.
Oh, that's fine. I'll be right next time, period.
The rectangular boxes, you're right, are their plays. But if you see that, they have a lot of extra, they have a lot of acreage, I guess I should say. I can't remember the exact number now that I put out, but it was 140,000 acres, if that's right. My Twitter thread kind of covers that. And I should say a lot of these rectangular blocks are totally unexplored because they're uneconomic. However, with oil-based drilling mud and with multi-leg horizontal drilling, they could become economic. It's the same story as a Clearwater. Somebody proved it out and everybody came rushing in paying $40,000, $60,000, $100,000 a flowing barrel and just went bananas over this. So, if they can prove out one of these blocks here, a contiguous block, jam 6 or 7 wells in there and prove it out, they could get huge money for some of this acreage. That's basically a zero currently. It's worthless because nobody's drilled there and nobody's proven it out. How much higher do you anticipate cost per well? So Surge has already upped their capital program a couple of times now, so I think they're already accounting for that. The reports we've got from some of the management has been about a 20 to 30% increase in D&C cost. That's for singular wells. If you have a program, so Surge has 3 rigs that are working full-time all the time, I think it's going to be maybe a little bit lower, maybe 10 to 15% inflation in there. So it does affect it. Keep in mind that the multi-leg horizontal wells are not cased and they're not fracked. So any problems with casing and any cost inflation on fracking does not affect these wells. The 55-day payout is crazy. Yeah, I don't think I've seen that before. I mean, Southeast Saskatchewan does have little pools that you can hit that just come on insane. But the fact that they were able to do it for 2 straight wells and they've let FarSky and Astra de-risk the position kind of tells me that it's going to be more so the norm than a one-off. You know, maybe not 55 days on every well, but it's going to be some pretty good development going on. What happened on August 21st? So Surge did an 8.5 to 1 share consolidation. That's why you see this big stock price jump. How does their FCF compare to Athabasca? Okay, so Athabasca just put out their latest results, an operational update, and they are guiding for $180 million free cash flow at 85 WTI in 2022. So $180 million. Their enterprise value is roughly $900 million. Surge has about $200 million of free cash flow. Their enterprise value is $850, so about the same, and a little bit more free cash flow. So very similar. I think I've shared my thoughts on Athabasca earlier, and I don't really want to get into it, but one company has a lot of catalysts to the upside, Surge. The other seems to lose money. You know, they should be generating more than $250 million of free cash flow, but they lose 20 million here and they lose 30 million there, and their production is declining next year. Their Duvernay wells are declining hard. They claim that their steam oil ratio of 3.7 is good, and it's the best yet. That's not very good. 3.7 is basically bottom 10th percentile for steam oil ratio. So there's other problems there. Does it have cash flow torque? I'm happy to discuss this with anyone kind of on a Twitter space or after the Zoom call, but if you run the same spreadsheet for MEG and you run the same spreadsheet for Athabasca, MEG has better free cash flow in 2022 and 2023, and they have better cash flow torque. So if the oil price goes higher, some people think that Athabasca is suddenly going to start making tons of money. Well, I can guarantee you that MEG on a percent basis ends up making more money. So for me, it's just not worth the risk. There's other catalysts for Athabasca like the short squeeze and such, but it's just not a play that I'm interested in at this point. Again, no recommendation. This is just my opinion and what I've seen and what I kind of think. You know, one could outperform the other substantially in the short term, but I'm looking for more the long term. Have you met with management for Surge? Yes, so I have met with Paul Coburn, Jared Dux, and I forget their controller's name, but I've met with them. They had a recent meeting with Adelaide Capital, which was really, really good. I believe it was Paul and Murray. That if you haven't seen that, shoot me a DM. I'll get you the link to that presentation. Any others you follow? Yes, so I do try to meet with management as much as possible. However, it's more and more becoming not that relevant because a lot of the information is already out there. and we've been trying to get them on Twitter Spaces instead of me meeting with them personally. So it's been working out great. Phil Hodge with Pinecliff is on Wednesday, I believe. Yeah, Wednesday at 2:30 Mountain. So that's another one, and that's a company I'm going to be talking about here next. So my goal is more to get them out into the public space as opposed to me chatting with them or talking with them personally, because it doesn't really change my opinion very much now that I've been following the sector for a little bit. Surge management is known for a little bit of promotion here and there, but you know what? They've produced results with Crescent Point. They produced results with Surge. Surge is paid out, I believe, share adjusted, it's like $9 to $12 of dividends already since 2014. You know, and since 2014, we've basically been in a bust cycle, and for them to generate that much free cash flow is pretty impressive. And when he says that they're serious about bringing the dividend back, you know, I believe it, and I believe some of the research they're doing, some of their well results, I think speak for themselves. And until that changes, I don't really see any reason to doubt what's going on. How will Surge fourth quarter reported results compare with peers? That's a very difficult question. I'll put it this way, that the hedges are going to hurt. Yes, guaranteed, big time. But Q4 is done. We're into February now. And if you look past that, you know, in early December, I mean, Surge is up 60% roughly, I want to say, since then. So, you know, I think some other people realize that, hey, these hedges are going away, and let's look into the future. It's looking pretty good. So I guess that would be my answer to that. The hedges do hurt them a lot. And even Q1, Q2, and Q3 and Q4 this year, it does hurt them a lot. But, you know, it's just one of those things when if they can produce this sort of free cash flow with such poor hedging, and their net asset value is going to keep going up because they keep adding reserves, they keep proving out more plays, I think there's a lot of catalysts here that will negate the loss of the hedges. And going into 2023, if you want to look that far out, I mean, this thing is just a monster. And I don't think there's many companies that come close on a 2023 unhedged free cash flow basis. So cool, I'll leave it at that. Any other questions on Surge specifically? I know there's a lot of people that wanted to know that, am I holding, am I selling, and why I keep holding and such. So I think that covers it, and I'm happy to talk about it more. Going forward, I will say that for anyone that listened to the Twitter space, I have worked the Macklin area. I operated there and did field engineering for about a year. So I know the area, and I know I personally have operated wells that randomly would start making 5 times the oil, or new drills that were 10x as productive as the others. So I don't think this is just a one-off case. I think they have truly figured something out here with the oil-based drilling mud and the multi-leg horizontals. And I'm willing to make a bet on that, because I believe the field, and I believe it's realistic what they're trying to say here. And there's a lot of potential in that Macklin area. There's a lot of undeveloped kind of acreage still jammed with vertical wells, which at the end don't actually produce that much. For previous seminar on Whitecap, will they be available? So Whitecap is the only one that's not available, because that was the first run I ever did of this kind of format, and so it was not recorded at the time. But every other company will be, and I'm happy to cover Whitecap actually in 2 weeks. Yeah, let's do Whitecap in 2 weeks. Bring that back to the forefront, because a company that has a lot of pros and cons, I guess. I'll put it that way, mostly pros. Cool. Okay. Okay, let's just get Pinecliff done quick, so that we don't have to take a break, and we can just end it here. That way we can get on with the rest of our day. So I'm going to tell you what. Let me make things easy. I've done Pinecliff already, and I think most people follow the format that I'm using. So I'll just go through the numbers, and then, I mean, I'm finding the numbers in the same place that I'm finding these Surge and Baytex numbers. So I'll go through it quick, and then I'll leave it for Phil on Wednesday to kind of talk about Pine Cliff more, and we can kind of give a good teaser to it. So Pine Cliff, that was their production for Q3. Again, on the MD&A, it's a gas company. They have very few liquids. It's mostly mostly gas and NGLs, and very little crude oil. They've recently drilled 2 new crude oil wells, so they are kind of trying to take advantage of this additional oil price. The Pecusco asset, they've drilled 2 wells that have come on very, very nice. I think over 150 BOEs each. Very cheap drills. Shares outstanding, share price, everything is the same. Their current debt is about 41 million. They made 13.3 million adjusted funds flow, 4 million free cash flow. Something that's important with Pine Cliff and with every gas company is capital. They spent $368,000 in CapEx in Q1, 1.5 million in Q2, and almost 9 million in Q3. So if you just look at it from a free cash flow perspective, you're getting the wrong idea, because they're not spending $9 million every quarter. They spend more money when the gas price is higher and going into the winter season, and their budget kind of increased a little bit, So if someone is looking just at Q3 and they extrapolate this number to all quarters, you would be so far off base. It wouldn't even be funny. It's such a big difference. So, this is not 100% accurate, but we'll leave it like that because those are the actuals. The Q3 pricing and strip pricing, exact same calculation. AECO pricing, exact same. And we get our, yields, pretty decent. It competes with Baytex and Surge, more so on a gas basis as opposed to oil basis. They don't hedge, so I'm going to leave that blank. It doesn't affect this calculation. They're not growing in Q4. However, they did close a deal at the end of Q4. So acquisition highlights about 1,900 BOEs at blah, 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 this much gas and whatnot. They paid $22 million cash for it. So when somebody pays cash for the acquisition, you want to put it as a negative in the sources of free cash flow for Q4, because that cash is leaving the company. Everything else is zero, nothing. We have our Q4 adjusted funds flow prediction, free cash flow prediction. Nothing really changes here. And then we add in the acquisition now. So this is where the whole company kind of turns on its head. Again, just like Surge, because of the acquisition. So how many barrels did they add? They added about 1,900 BOEs. And what's the netback? We can't use the Q3 netback. Why is that? Because in Q3, Pine Cliff was about 92% gas. Gas has a lower netback than oil by a significant margin. Their acquisition is only 71% gas. They actually acquired a bunch of high netback oil here. So how are we going to calculate the netback on this acquisition? So they give us a few numbers to work with, and thankfully, that's all we need. So we take the $22 million and you divide that by the adjusted funds flow multiple. So what they're telling you here is that it's going to take 1.7 years for them to pay off this $22 million using adjusted funds flow. If they don't spend any money on this asset, adjusted funds flow equals free cash flow because CapEx is zero. So we take 22 million and we divide it by 1.7 to give us our adjusted funds flow for the year. And that's what we did here. That's for the year. We divided by 365 to get the adjusted funds flow per day, AKA the netback per day. And we divided by the number of barrels to get the netback per day per barrel, $18.83. So that's what I'm going to put in here. 1,900 barrels at $18.83. if you look at what management is guiding for 2022, there's an additional 800 BOEs that's going to come online. Why? Because they did a bunch of drilling. They spent this $9 million in Q3 to add some high quality oil wells. And they tell you what these wells are producing. The wells are producing these 2 Pecusco wells combined this much BOEs, and it's mostly crude oil. Unlike the rest of the company, this is mostly crude oil. It's about 55 to 60% oil. So the netbacks are going to be even higher. So, you know, if the netbacks are $18 at 23% oil, at 55% oil, we can say the netbacks are maybe 30, no, more than $30. I'm just going to say 20 and be very conservative. Very, very conservative. You can put in whatever number you want here. I'm assuming because they opened up a new oil area, they're going to need a little bit more operators. So that's going to affect the netback a bit, you know, blah, blah, blah. And you can make your own deductions. You average this out, it's about $19 netback on 2,700 barrels. We put that in there. We get projected adjusted funds flow of $105 million for 2022. The capital for 2022 is 20 million. How do we know that? They give us a nice little table here. And if you take adjusted funds flow minus free cash flow, that's exactly 20 million. So 20, and we have a projected free cash flow at strip of $85 million, which is an even higher yield than surge. So looking very good. And I'll just go back here. I'll put $4 in for the AECO strip, and we get 76 million for the projected free cash flow at $4 AECO. Management says that at $4 AECO, they're getting about $77 million free cash flow. So the spreadsheet is actually quite close on this. If you think the netback on this oil asset is a little bit higher, you want to say 22, you know, the spreadsheet is basically bang on what management is presenting. So, you know, this is one where I'm happy. I don't need to do any other research, and I'm, you know, it's pretty closely following this. Again, about a 20, hang on. So the strip gas is 425 right now. So we are roughly a 30% yield. And the nice thing about Pine Cliff, if you believe in AECO gas, and I have no position in Pine Cliff. I'll go up front and say that, full disclosure. Even with the high yield, I think there's some, I don't believe in the gas story as much. AECO gas, it can be very volatile. You can make a lot of money as well. So if you think that with coal to gas switching, with the LNG Canada coming online, extra intra-Canada demand for gas, let's say you think AECO gas is going to hit, you know, 525 for 2022. So if that's the case, look at the free cash flow yield. You're getting a 42% free cash flow yield. Absolutely blows everything else out of the water. So Pine Cliff has a lot of upside torque. I cannot lie about that. That's fact. It has one of the highest free cash flow torques if you believe in higher gas pricing. So, you know, every time somebody tells me that they're buying Tourmaline or Birchcliff or Advantage, I always wonder, well, why? You have a bigger company with those, yes, and you get the special dividends and whatnot, but the actual yield is so much lower than what some of these companies can print at $5 gas or $4 gas. So, you know, if I was to get into the gas game, the natural gas game, and really see strengthening AECO pricing, this would probably be the name I would do a deeper dive on. Again, no recommendation. I don't have a position. I currently don't have plans to add a position. But, you know, I always keep an eye out for increasing torque. And if the strip changes this way, which companies should I be looking at? And always keep that in the back of your mind. If condensate prices all of a sudden start rising, if NGL starts rising, where do you want to be positioned for those quarterly results, for the earnings, for the free cash flow? And for the gas plays, which I don't talk about very much, This is one of them. And I'll end it here by showing you the Canadian natural gas storage levels, even with a warm winter, are sitting very low, almost at the 5-year minimum. And the Ngl Strip has risen considerably in the last month, in the last week, especially. Like, it's gone up a lot. And what's causing that? That's European natural gas pricing pushing the Henry Hub pricing up, and cold weather in the US, and that in turn pushes the AECO pricing up. So, it's not really a global system, but with LNG more and more coming online, it is more so a global system. So, if you think this European gas crunch is going to continue, the Russia-Ukraine geopolitical issues there, if you think European gas is going to spike again, and bring US gas up with it, and AECO up with it, let's say it spikes to $7 for the next year. We're trading at a 64% free cash flow yield, and with the crisis we've seen in Europe and the gas price go way up and then sustain there, there's a lot of arbitrage there for American companies to bring gas there. So the whole sustained natural gas higher thesis could have some legs behind it. And again, I'll let Phil talk more on Wednesday, but a name that isn't talked about very much, so I wanted to bring it up because I like talking about new, different names, things that people aren't really considering, things that aren't popular on the Twitter space. Maybe throw a little fresh idea in there. Yeah, so I'll throw that in there. I'll leave it at that. So that ends kind of the valuation seminar portion of it. I'll leave the Zoom call open now to any questions on the macro, any companies you want me to discuss. And then once that ends, I'll come back to the Twitter space and basically leave it open for Canadian oil discussion, I guess, open. Okay, so can you comment briefly on Baytex? Baytex is a company that I've never been interested in because they have no debt. They're buying back shares. They don't get the share appreciation when the price goes up. And when the price goes down, they get dumped just as hard. So why would I buy a company like that? There's geopolitical risk in Colombia along with that. So I think it's Colombia anyways with Baytex. So I think the COVID crisis has heightened people's attention to the fact that the blue chips and the debt-free companies, it doesn't matter what you are. When the oil price goes down, they all get smacked. So if that's the case, well, I'm going to buy a higher torque name to capture more of the upside on it. Thoughts on TVE? So I like TVE. They've got to roughly the 40,000-50,000 BOE range, which is kind of required now to get some attention. Nice acreage in the Clearwater, and Charlie Lake, I believe, has some exceptional has some exceptional Charlie Lake wells. It's a great play, but nothing in there really stands out to me compared to some of these other names. It's just another name out there with no real catalyst on the horizon. They have a bunch of poor hedging. Yeah, I don't see it as something that could outcompete with anything I already have, because for me to get out of one of my positions and into something else, I mean, there has to be a substantial reason. It can't just be a 0.5% or a 1%, here and there. i3 Energy, huge fan. Full disclosure, I got in at roughly 18.5 cents. I know the acreage. I discussed i3's valuation in last seminar. I've worked the Wapiti Cardium. They have some exposure to the Clearwater. The Simonette Montney is really good. The Cenovus Deep Basin has a lot of optimization that can be done at very good capital efficiencies. Repsol just FID'd an offshore project in the North Sea right next to i3's Serenity block, I believe it is. So a lot of catalysts. They've come out with a monthly dividend now, roughly a 7% yield, which is now down to 6%, I guess, because the share price has come up a bit. and just generating gobs of free cash flow. And a bonus, if ACO keeps going up, they have roughly 50% of their production as ACO. So yeah, I couldn't be happier with my purchase of i3. And I know some of the field guys in the Fox Creek area, the Valley View area, very happy with the way things are going. You know, great guys. So I'll kind of leave it at that. And looking forward to the operational update and the dividend announcement in the next couple of weeks. Have you done calculations on gear energy? Okay. Nobody who's invested in gear is going to like this answer. Gear is possibly the most overvalued company on the TSX in the Canadian oil and gas space today. They trade at less than a 10% free cash flow yield. The reason for that, I couldn't tell you. It's done exceptionally well. So I mean, it's gone from $1 to about $1.60-ish, I want to say. So there's something going on. Ingram, very, very strong management team. HFIR is on the board. A dividend is imminent, I believe, and the net debt being paid back is imminent. It just doesn't generate the cash flow that I need. It's not even close. So I'll leave it at that. Yeah. What time on next Wednesday? So the meeting with Phil Hodge is Wednesday, 2:30 p.m. Mountain Time. It will be on Twitter Spaces, and it will be run very similar to how Journey and Hemisphere were run. So a few minutes for Phil to kind of talk about his company, his career, catalysts, etc., and then open to the public to ask questions. And Phil, I believe, is the chair of the EPAC, which is the Explorer and Producer Association of Canada. Don't quote me on that, but I believe that's the case. So he's got a lot of good insight on stuff industry-wide, not just with Pinecliff, but kind of what's going on in the industry overall, and a good lead on that kind of stuff, which is always information like that. You can't buy it. It's, you know, it's certain people know these kinds of things, and I'm very excited to have him on there and kind of share some of his insights. Yes, so Pinecliff has some of the lowest decline rates in the industry, roughly 9% on existing production, roughly 12% if you add in the new drills. Exceptional, just exceptional. They don't spend much money on capital. Like, they could go years without drilling a well and not lose that much of their production if they keep their workovers and optimizations going on. So, you know, if the oil price drops, if the gas price drops, very low risk. There's not much going on out there. PRQ has a good growth profile. Yes, correct. PRQ has also benefited from being on some podcasts and other marketing material recently. So I do like the company. I like betting on the Gray brothers. You cannot go wrong. I think Peyto was 100x play in 70 years or something. Yeah, something like that. That being said, I don't like the Petrus acreage. It's too close to the fringe of the Cardium, where it turns into gas as opposed to oil. Can they drill good wells with the team they have? Absolutely. That is one team that can blow it out of the park and drill exceptionally good wells. Geology, engineering, everything is bang on, top notch. But for me, it's just I don't see why I would invest into it at this valuation at this point. But yeah, it's a good growth profile. They got some nice Ferrier Cardium plays. They got some land, I believe, up by Grovedale, south of Grand Prairie, somewhere there as well, which have come on pretty strong. Yeah, you can't bet against the Gray brothers. That's fact. Okay, so Saturn Oil and Gas. I did mention it. Yes, I have done a deeper dive into it. Yes, I've run into a kind of a conflict of interest, so I can't share my thoughts publicly on it at the moment. Saturn and Suncor are the two where I've run into this issue. and I hope these things kind of fix themselves in the near future. But I just can't talk about it at this time, and I hope to talk about it soon and even cover it in one of these valuation sessions in the future. Thoughts on Vermilion? Love it. I absolutely love Vermilion. The free cash flow they're putting out today is top 3, top 2 maybe. Even at their valuation now, it's gone up roughly 60, 70% in the last 6 weeks, 8 weeks. Phenomenal. And the assets suck. The inventories are not that good. 5 years down the road, 7 years down the road, they're going to have a huge problem with inventory and decommissioning obligations. But you know what? If they can generate the kind of free cash flows they're doing today, and if they can avoid making any huge acquisitions that take up free cash flow, I'm pretty happy with it. There's a dividend coming back in right away, actually, maybe within the month, and you know, that's an extra catalyst. I think they're going to go more than 6 cents, you know, eventually, if not right away, per quarter. Like they could, I think, what was the calculation I did? I think they could 30x their dividend just out of free cash flow. So pretty crazy stuff there. And you know what? As long as I can kind of get out in a good time, I think it's fine. I'm not worried about the inventory problem at this exact moment. Yeah, I'll leave it at that. I don't have equity in Vermilion. I only have the December 2022 options. Just because I think the next winter is also going to be a high European gas pricing. And I'll just sit there and collect my money on that. It's done well, to say the least. Would I make a short-term play on tanker names, given renewed discussions on lifting of sanctions? I don't know anything about the tanker side, unfortunately, and I don't want to rub salt in the wound, but I've been hearing about this tanker play for like 2 years now, maybe longer, and it hasn't panned out. So I think there's more happening there than I know, and I just don't care to go into it when I have such great valuations here still available. If this changes and these companies re-rate, yeah, I'm more than happy to look at other services and other resources and such. But at this point, there's so much work needing to be put into the E&Ps. I just don't think I can spend time on tankers and make a conviction play on it. Any thoughts on Athabasca? Yeah, I think I've shared my thoughts quite a bit. It's made me a lot of money in 2021. At this point, I don't like it. I don't. There's just too much going wrong there. I had a note shared with me on the recent operational update from BMO, I believe, that they said we can't figure out where the missing cash flow went, and I just laughed and laughed. Like I was rolling on the floor laughing, like literally, because that's been my exact question for the last 3 or 4 years: is where is the cash flow going? It's just nickel and diming here and there, and it's all gone all of a sudden. So yeah, I'll leave it at that. There's a bunch of negative catalysts coming up. Their JV with Murphy and the Duvernay is now done, so Murphy is no longer subsidizing that. I don't think their steam oil ratios are any good. Their production is dropping next year with a pretty significant capital budget, so that's not really a good sign. Can it make you a lot of money because of the short squeeze and because people get on the FOMO train? Absolutely. But that's not really how I like to invest, based on things that could happen when I have companies for sure generating free cash flow. And this is not a knock against any company in particular. I don't want it to be like me complaining about something. It's just what I see. And people have completely opposing opinions to me, and they make a very fine case as well. If oil price went to $110 and Athabasca was still $1.40 or $1.50, well, yeah, I would definitely be quite interested in building a position. But like I said, where it is today, I compare it directly to MEG. They both are roughly a 18 to 20% free cash flow yield at strip. At $100 oil, Athabasca is roughly 26% FCF to EV, Meg is 30. So, you know, why would I not go with the name that's got a bunch of catalysts upcoming? They got a share buyback. Meg will be shortly. They're paying back debt. They're outperforming on their production numbers for November and December. So until Athabasca can beat that, I will be out for now. PetroTal, big fan, big fan of PetroTal. I received a consulting call on PetroTal in October, November-ish time. Spent a lot of time on it. Not really a deep dive, but just kind of understanding the company and understanding the reserves and the potential here. Did that, and I had a pretty conviction position to buy in early December at 30 cents. And they solved the social unrest issue that weekend that I had collected a bunch of money to get into PetroTal, and it jumped 20% at the open. And I've been waiting for a dip, and I'm still don't have a dip. So I guess the Well 10H is coming online in February end, I believe. So that's another 7 or 8,000 barrels a day. And you know, somebody had mentioned to me that the social unrest issue is a constant, ongoing in Peru. You cannot fix it. It's just a society thing that happens right now. So you know, if I can get in on an extended issue, some sort of shutdown, I will. But until then, I think it's just got too much legs and too much backing at this point. I don't think I'll be able to build a position. Thoughts on Ovintiv? I don't really have much thoughts on it. It hasn't been managed well. I don't think through the downturn they could have made a lot. Like it's a 25 bagger already, but it could have been a 50 to 75 bagger if they didn't come back in and hedge the rest of their oil at really bad rates. So I don't know much about it. It's one that I think is way overly valued at this point. So I haven't even looked into it. I think they got a big boost though from going into the US and headquartering there and being on the American exchanges. So something to be said for companies doing that. Speaking of gas, would I ever evaluate Tourmaline? Tourmaline is too much like a CNRL to me. They both generate 15, 17% free cash flow, and it's just steady Eddie. The company is not going to double or triple in a year. It could if gas prices went up substantially, yes. But I see better risk reward, more upside on some of these other names out there. So it's just too big for me, and I'm not a fan of the special dividends. If someone can explain to me why they like them, I would be more than happy to listen in. I think share buybacks are a way better way of returning capital at this point for the majority of companies, including Tourmaline. You know, until they trade at that 8 times free cash flow, I think share buybacks is the best way. Having a little dividend in there so that some of the dividend funds and some of the retirees and stuff can get in. Yeah, that's a good plan. But the special dividend, I just don't get it. I don't understand the reasoning behind that. Bonterra. So I'm going to be covering Bonterra in early March. I like the company. They're doing what they're doing. I don't really have much thoughts on it. It's not one that I've really looked into deeply. The CEO of Bonterra, George Fink, I believe, is on the board of directors of Pinecliff. So very invested people, very hardworking people. I think George is like in his 80s or 90s, and he still dresses up and goes to the office every single day. And you got to respect people like that who really care for their company and put in the work. But Bonterra is one I've always kind of shied away from, and I don't really have a good reason for it. Yeah, fully honest. Journey energy thoughts. I think this has been discussed at length, so I don't want to say too much more. I had a position earlier when I saw the huge potential in it, and I made a pretty good return on it, and I moved it into another name that became a little more attractive given the share price rise. So I'll leave it at that. I like the power gen business. I think it's very smart, especially if you can borrow against it and you can get the valuation for it. I think it's phenomenal, and I think they're going to be doing well here going forward. I think one of the big things that people don't really talk about is production outperformance. I looked at TD's latest Q3 assumptions for production, or sorry, Q4 predictions for the production, and some of them are 5 to 7% off, in my opinion. And I could be definitely wrong on that, but I'm following the well results. I'm tracking some of the data on PetroNinja, some of the public data out there, and it just doesn't make sense where some of these people are coming up with these production numbers. So, a 5% beat may not seem significant, but you extrapolate 5% beat with oil at $90 over a year, and you could have a 10 to 15% increase in your free cash flow. So I think it's pretty important that we need to look at companies like this. And where was I going with it? I believe Journey and Spartan Delta and Surge, maybe Baytex to some extent, will beat production by a few percent, low single digits, and it adds up to a lot. So just keep that in mind going forward when you're looking at these companies. There's some of them that are drilling damn good wells, and the market doesn't know this because the market doesn't look at well by well results that often. My thoughts on Enerplus with the coming sale of assets. I don't really have an opinion. I don't think it's going to change very much. Converting all the numbers to US dollars, again, it doesn't change much at all. I'm pretty bearish on the Bakken overall. There are some people that would highly disagree with that statement, but I just think the Bakken is just not a good asset anymore. There's some companies drilling monster wells still, and there's little pockets in there, but overall, it's a maintained production kind of asset, and it's just not something that I'm not interested in Bakken companies, especially after I've shit talked it so much on Twitter over the last little bit. I think unless somebody can show me concrete proof that there's a lot of acreage left in the Bakken where people can drill really good wells for the next 2, 3, 5 years, yeah, it's just not my bag. Not saying it's a bad company because they are drilling pretty good wells, Enerplus specifically in the Bakken, and they're becoming a pure play Bakken producer. So obviously they have something that they've seen there. How often have you rolled companies in the last year? I don't know what rolled means, but I had Athabasca was my biggest position early 2021. That went into Pipestone, and I sold out of Pipestone being my biggest position, and I got into Surge, and that's kind of been it. I've built positions in ARC, ARX, Meg Energy, and some of the options. Crescent Point, I've traded a little bit up and down. Yeah, I3 Energy I've bought in. There's some other companies I've gone in and out of, but not the major, not a major position by any means. Tamarack Valley I spoke about here earlier, so I'll leave that for now. Leave that for the recording. Headwater has great exposure to Clearwater. It's also trading at $100,000 a flowing barrel, and their step out wells have not been good. So risky, very risky. I'm not a fan at all. So I'm going against the two biggest fund managers, energy fund managers in Canada by saying that, but I don't see the hype in Headwater. It trades at a very, very high premium, and they've run out of core acreage. You know, so unless they can prove out that their step out wells are getting better, more economic, I don't really see a reason to buy it at this point. And Cenovus exiting their position was kind of the cherry on the top, where I think I agree with that and the time they got out at. These names are too safe. What about Razor Energy? If I can easily at $80 to $90 oil see a triple in a company like MEG or ARC or Cenovus by December 22, I think I'll take it, because why would I go into more risky companies when I can buy options? Back in November, December, when I bought my options, some of those options have already tripled since then. And I don't think you can say the same for these companies like Prairie Provident and Razor and Petrus. Maybe Petrus has tripled since then, I guess, because of the media stuff. But Athabasca, you can't say the same. So for me, it's, can the small cap companies beat the options? Because the small cap companies are basically call options, to me. And unless I see one of them that can really somehow generate a ton of cash flow that they haven't been generating so far, it just doesn't interest me. I do follow them a lot. I am doing some research on a couple of names, new names to me, to look into, because the call options have gotten more expensive since December. They don't offer the same upside they did back then. So the valuations are getting closer, and I think Razor has a lot of power gen capability as well. They have a bunch of production coming online. So there's a bunch of catalysts there, but you can't build a position in Razor. If you want to buy, let's just throw a number out there. If you want to buy $500,000 of Razor, it's going to take you a month. So, and it's going to jack the price up 20, 30, 40%. So what good is it really? In a way. Bakken is true crowded in the best locations. Yeah, I think I've posted a couple of graphs about that. So that being said, that's where the opportunity is. If someone can come in and prove out the fringe a little bit, and it's some sort of half decent core tier 2 position, can make a lot of money. That's what Petroshale is trying to do. Managed by the old Torque Oil and Gas team, very strong management, but not my thing. Again, the Bakken is just not my thing. Do you take investor dollars? No, it's my fund or whatever you want to call it is completely closed ended. I just like to share my my portfolio and kind of what I'm doing. I think I've heard a lot of comments that people are happy with the transparency that I put out. So I appreciate that, and I hope to continue that. Kind of update my portfolios every month and share my thoughts on the names and kind of what I'm seeing. And so far I haven't really had to invest in any illiquid microcaps or anything like that, so it doesn't really bother me to do that. Yeah, I think that would be a good way to put it. And I guess just to put it out, I don't have any plans to ever start a fund or any investment services of any means. It's just this is very fun to me. It's a passion. I enjoy it. I can kind of set my own hours. I can do my own thing. Nothing stops me from doing and going on Twitter and talking about these names and writing articles. And I think if it became a job, or if investors were calling me, it just takes the fun out of it. So I currently don't have any plans for any such service, but I'm more than happy at any time to jump on a call or a Zoom or a meeting and talk. I absolutely love that. And like I said, I've had some excellent calls over the last couple of weeks. Just amazing, the in-depth conversations and kind of people sharing their stories. Yeah, that's my jam. So please keep doing that. TransGlobe Energy, I don't have much to offer there. I know they're in Egypt, and there's a bunch of concessions that recently got given out. So there's that, but it's just too much geopolitical risk in a way. I don't understand Egypt much, and there's a lot of risk that if the Middle East war was to break out between the Houthis and Israel and Libya and Iran, I think Egypt would get involved, and just not really interested in playing that at the moment, given where the heightened tension seems to be. Like Dr. El Haji mentioned yesterday, a drone attacking the Abu Dhabi airport and killing 3 people. Yeah, if like people just ignored this news and said, "Oh, whatever, this happens all the time." Well, I'm telling you right now, it does not happen in the UAE, in Abu Dhabi, and that to killing 3 people and blowing up 2 tankers right next to the airport. Yeah, that is not a good sign at all, and that kind of has heightened the geopolitical risk in my head more than I think maybe the other people. I think this is like, that was a big thing that I think the market just kind of ignored or put under the rug. But it was a big warning sign to me. And with what Biden's doing now in Iran, yeah, I think I don't want to be the guy spreading paranoia, but I'm definitely keeping a close eye, much closer eye now on what's going on. Oil services. I wish all the best to oil services. They have gotten hammered for the last 7, 8, 10 years. I've personally worked with oil services companies who are working right to the bone, making less than minimum wage some days, just to keep their contracts, contracts ongoing. And it's just been tough. It's been very, very tough for them. So I wish a lot of good future on them, but I just don't see it. The internal inflation on these service companies is 18%. Can they pass that on to the E&P? Maybe. Can they build a margin on that? I don't think so. As far as the drillers and the service rig guys, there is, like, I'm trying to stay connected with Grand Prairie a lot and the people there, and there is literally no steel and no people and no equipment. It's you can't raise rates when you don't have the people out there to add more rigs or to add more swabbing equipment or wireline equipment. It's going to be very tough on them to really increase margins by a lot. There's talk that there's going to be a bidding war on these service companies. I highly doubt it. The companies in the Montney and the Duvernay, they just don't operate like that. They don't operate on a willy-nilly, oh, let's just pay 30% extra for the drilling rig kind of mentality. They are very, very strict to the bone and signing long-term contracts, and very, notorious for watching costs and making sure their AFEs are right up to snuff. Maybe that wasn't the case in 2016, 17, 18, but I'm telling you, there's a heightened awareness of all this now. When I worked in Grand Prairie, like, there was things like, buying plungers and buying well plungers and bottom hole equipment and even like box of pens and stuff for the field shack were getting questioned, and making sure you're ordering the right things and whatnot. So it's I don't think there's that many dollars that's just going to be randomly come up and become available for people to spend on extra margins for the service companies. But that's just my opinion, and I would love nothing more than for service companies to do well, because they have really suffered, and some of them have invested millions and millions of dollars into oil field equipment. And I'm talking more the private now, not the public guys, but the private people, into trucks and into equipment and shops and whatnot. And they've just gotten railed over the last few years, and you know, I would love for them to kind of share in a little bit of the pot of gold, I guess. What are your current favorite available options? I don't really have a good answer to that. I like ARC, ARX, and I like MEG. Those are two that I think are still undervalued and can go up a lot. Synovus, if you want to play the long dated options, and assuming that they don't really increase the dividend too much, I think could be a good play. Other than that, I don't really see much. Grand Tierra actually is one that you might want to look at. It's a stock that trades at $1 that has options. So need I say much more on that? But again, that's not a recommendation. That's just what I'm seeing, what I'm kind of keeping an eye out on. I like the Synovus February 18th for this month, which I bought a long time ago, because I think this is a pretty big earnings announcement with them hitting their $8 billion net debt. So, but I did buy that a long time ago, not right now. Nobody talks about in-play oil. I did a valuation on in-play like about a month ago. So, and that was the post-acquisition valuation. So, very, very solid free cash flow yield at the time. It's gone up a lot since then. So, again, it's just priced itself out. Once the stocks are up 50, 60, 100%, they stop being competitive on a free cash flow basis. So I like the name, I like the management there, I like the play. I like the acquisition a lot of a Prairie Storm, but just too expensive now for what it is. Odds of Biden ever banning exports. You know what? If the US produced heavier oil, I could see that happening in a way. But you know what? If Biden banned exports today, you're gonna have all this light oil and condensate sitting around that the US refineries can't process. So what's gonna end up happening? You have all this oil sitting around that your refineries literally cannot process. And then what? You end up nowhere. It would be the dumbest thing ever, and which I think the SPR release also was. Yeah, I just don't think this one is going to happen. Big oil still has a pretty decent lobby group, despite what people say. Big oil does a lot of lobbying, and I don't think this one is something that's going to get through. Your thoughts on royalty companies, Freehold, Topaz, Prairie Sky? I like them. They're decent little yield, dividend yield on them, a little bit of growth as companies start drilling more, but they fall just as much when the oil price drops, and they don't give me the upside torque. So it comes down to the same as a company like Baytex. It's the same thing. Why would I buy a company like that? I don't think people. I personally am not in the energy trade and not interested in spending all this time researching stuff and going through macro and whatnot to make 20 or 30% or 40% on a freehold. I'm looking for a 200% on a MEG or a or 600% on one of the options that I'm playing. We only get these bull cycles every so often, and when we have a bull cycle, the stocks shoot up. You go back to 2008, 9, even 2016 to some extent. You can find names that were up 5 to 10x within the year, and that was from oil going from 40 to 80 to 100. Well, this time we had oil go from -40 to 60 to 80 to potentially all-time highs. So, extrapolate that. You could have plays that are 25, 50 baggers and swinging for the fences. And the risk reward is looking very good so far. Can you speak to a large international company like Petrobras? No, I don't know anything about it. I will say that the Brazil pre-salt offshore was overhyped. I don't think it produces at the same rate that they expected it to. So I think there's companies getting interested now again, but it's going to be slow and steady because I don't think some of the reservoirs have panned out the way some of these majors thought. Petrobras themselves might spend some money there, yeah, but I don't follow it, so I don't know. MEG long-term options scare me. What if they get bought out? Yeah, fair point. You lose your premium you paid up front, so it's a risk. Yeah. I don't have MEG options. I have the MEG equity for that exact reason, because I think it's one that if they do get bought out, it'll have to be a 25, 30, 40% premium. I don't think anyone can buy MEG at the price it is. I think Husky bid 60% over 60% or 50% over the share price, and they still couldn't get it. So what does that tell you? Bonterra came in second for the bidding on Prairie Storm. Okay, cool. Good to know. I did not know that. So that's a very interesting insight. Have you looked into OYL FEC since the discovery? Okay, so again, one that I have, I think, a very counter view on this. And my view is, if you're buying the shares today, what do you expect is going to happen? I'll leave it as that. Like, where do you see the money coming in the share price? They haven't even proven out the discovery yet. They just know that there's a gross pay system there. So if they can prove out a net pay system and that it's in commercial quantities, will you get a little boost? Yeah, absolutely. And then what? They don't have the funding to bring the wells on production. It's going to take them roughly 5, 7, 10 years. It took Exxon and Hess 5 years to bring their first Guyana production online. If you look at OYL and FEC's block, it's only the top third to 40% of the block that really contains oil. The bottom 60% is too shallow and too close to land, in my opinion. And if they were drilling there, it's a big risk. It's a huge risk you're taking on, because Exxon has not discovered anything that far inland out of their 21 discoveries. Frontera's discovery is also very close to Suriname. It's not that far from the one well Apache drilled that was didn't have enough oil to be commercial. Suriname has other problems with water production and fault lines. So do I see potential in this play? Guaranteed. But there's a lot of question marks there that I'm just not personally interested in it. Like, 2 years down the road, if they drill 4 more discovery wells and they have found 5 reservoirs, can they get bought out at a huge premium? Absolutely. But you know what? I can sleep at night, and I'd be happy getting a 3x or a 2.5x on my current plays at $85, $90 oil. So there's no reason for me to go into exploration plays, but they've done a really good job, and they've performed, and they've got the gross pay figured out, and there's potential here for a huge re-rate to the stock, especially OYL, because they're a smaller company. So yeah, I think I'll leave it at that. It's not up my alley, but I can see why it would be, especially if somebody got into OYL at $1.15 or whatever. Yeah, but where it is today, how much upside do you really see? That's the question I would ask yourself, and in what time frame. Recon Africa, I have no comment on this. Until they can prove out that they can produce this thing properly, again, it's the exact same story as a Frontera. They claim to have a working system. I don't know what's happened over the last year. I really haven't heard much. And the countries that they're in, they pay a royalty, and which is pretty high. They pay a tax rate, which is very high. And then they have a profit sharing on top of that. That is very high. So I'm taking on exploration risk. Then I'm taking on development risk. The stock is already pricing in, pretty lofty expectations. And then of any profit that they do make, the governments and the NOCs and whatnot, they take 70, 80% of it. So where is the upside? And I'm always happy to listen in to anyone who wants to talk to me about some of these names. My phone is always open. I don't just throw these out and I'm just not interested at all. It's if you can make a case for it from an economic standpoint and what you're saying makes sense from a geopolitical standpoint and from a development standpoint, I'm more than happy to listen. But no one has been really able to make a case for Recon Africa at the current valuation. I mentioned exiting Pipestone for Surge. I love Pipestone. That is a name that I wish I wouldn't have exited. I think they've done really well. And if I was still in Pipestone, would I sell it for Surge today? I believe so, yeah. I think I would, because I see more catalysts coming up for Surge. Whereas Pipestone, if I'm buying Pipestone, why not buy a Spartan Delta or a ARC? I think they trade at better valuations. I think they got more land. Pipestone has a lot of unexplored acreage. If they can go into there and prove some of it out, their net asset value goes up a lot. Their production is rising. Pipestone, they're still generating free cash flow. Liquidity problems with Pipestone a little bit. It's hard to build a position. But I'm very happy with any condensate play right now. Pipestone, Spartan Delta, ARC, even Crew with their extended reach horizontals are doing very good. So I think so. I think I'm just in too many plays right now in the condensate area. But those are the two plays I'm kind of focusing on these days. Is the heavy oil, long reserve life kind of projects like a MEG, like a Synovus, like a Surge, with the multi-leg drilling as well, or the light condensate gas plays like Spartan Delta and ARC. And those basically cover the majority of my portfolio. I'm not in many gas names. I'm not in many light oil scattered producers. In fact, not at all, I want to say. I3 being kind of the little gem that I found, I guess, that was so undervalued that I just couldn't help myself. But for the others, that's kind of the two kind of areas where I'm seeing a lot of potential for growth, share price growth. Do you have any opinion on Peyto for nat gas exposure? Peyto is just steady Eddie. There's not much going on there. They have a lot of hedging, which has actually done decently well this year. And I think it's fine, but I don't think it's just not the same cash flow. Again, Birchcliff, Peyto, Advantage, it's all kind of the same thing. There's nothing that differentiates one from the other. And they have to be showing me something that I don't see elsewhere, and I just don't see it. If Pinecliff is trading at a 30% FCF to EV at 425 ACO, none of these companies beat that. So it's it's basically a waste of time. And then I have to deal with the hedging problem with Peyto and other issues with the Montney plays. Some of the Montney plays in BC don't have permits anymore and whatnot. So yeah, I can't make a strong case for any of them. Thoughts on Africa oil? I don't have any thoughts. I think, however, I think people are misunderstanding a little bit on this company with their debt situation. And somebody said it was a 200% free cash flow to EV. Didn't take into account the fact that they own this other company 60% or something, and they have to pay its debt. It's just too messy for me at this point. Cardinal is unhedged, will be debt-free soon, but share price has been lagging. Yeah, Cardinal is actually a really good company. They're from a cash flow perspective. I covered it earlier this year or maybe in December. So I like the free cash flow there. But Cardinal is very similar to Athabasca in a way. In that if a company has so little BOEs and they need 10 vice presidents, something just doesn't, seem right. So it's one of those where, will they make free cash flow? Yeah. Will they lose a lot of it to unknown reasons? Potentially, yes. I think there's a possibility of that. And I don't want to be throwing out accusations or anything like that. It's just my opinion, what I think. Any company that has such little BOEs with 10 vice presidents, it's a foreshadowing in a way to what's happening within the company, to their G&A cost structure. Just something off, and it's the same that I feel with Athabasca. Yeah, so this next comment basically agrees with me entirely with what I say. I think they still do well, but I think you have to mute your expectations a bit, just given the way the company's run. So Petrotal, I talked about Petrotal earlier, so I'll leave that for the recording at this point. So I think that covers the questions. So that was amazing. That was a lot of questions and really, really great stuff. In-depth questions as well. So I appreciate that. And I think I'll just reiterate that this recording will be on the website shortly. And the previous recordings are also on there. So I've covered a lot of companies, 15 to 20 companies in the past. I will update the next 2 Saturdays from today, those companies shortly, and go from there. And my DM and my email is always open. I'm happy to talk specific companies and discuss macro and whatnot. So happy to do that. I did talk about gear here. I see there's another question here. I spoke about gear earlier as well. So I'll leave that for the recording as well. Yeah, once again, appreciate everyone tuning in. It really means a lot that you spend your Saturday here, a few hours doing that. And for anyone that's new, again, the macro outlook will continue 2 weeks from today. And if you want to have a look at my latest stuff, it's on the website, the January 22nd, I believe. And yeah, I'll go from there. I look forward to everyone at tomorrow's meeting with Dr. Alhaji, and then Wednesday with Phil with Pinecliff, and we have Royal Helium on deck and Prairie Provident Resources also on deck. So maybe later in February we'll go from there. And yeah, hope everyone has a great rest of the day, and we'll see you all tomorrow. Cheers.